It's been messy for the cyclical side of the market.
You don't want to have a scenario where tech and tech capex slows down.
The market's back where it was, or heading at least in the direction of where it was last year.
You can take a look at where risk is priced right now, and I think reasonably conclude it's a relatively rich.
The market figured out and kind of agreed with me that the economy was resilient and we're not going to have a recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, this hour, the president pushing for a meeting between Putin and Zelensky. Home Depot kicking off a week full of earnings from retailers in America, and global bond yields inching higher, heading into the Fed's annual get-together in Jackson Hole, Wyoming.
So is this the quiet before the storm, or just the quiet? Because it's August and a lot of people want to go on vacation, and I think about that at a time where you have the potential risk events of retail sales coming in and hinting some concern about a consumer, or Jackson Hole maybe not necessarily seeming as dovish as being risks to the downside. Is the pain trade still higher? And that's really what I want to understand at a time where we're still hovering near all-time highs.
We're going to turn to Home Depot numbers in just a moment, but let's just sit on the bond market just for a beat. Long end of the curve, 30-year bond yields, multi-decade highs. In the UK, in Japan, close to those levels. The US 30 bond year inching back towards 5%. Is this becoming a problem for central bankers yet?
It's definitely becoming a problem at a time where you pinch a lot of those longer-term yields to borrowing costs like mortgages, et cetera. But it also highlights the international feature of this bond market at a time where inflation still is substantially higher than where it was in the past. Look, this is the crux of what we're going to be looking for at Jackson Hole. They're going to reassess their framework. They're going to talk about how they balance their dual mandate of both employment as well as inflation. And they're doing it at a time where inflation has been markedly higher. This is a new paradigm than where they were, say, 5-6 years ago when they first were coming out with this. And all of a sudden, they have to consider this is a global inflationary push with the build out of infrastructure, with all of the tariffs and the post-pandemic realities of supply chains.
Are they seeing any demand side destruction? Here's the headline on Home Depot just crossing the screen. Soft demand for big ticket items. Are we going to see some more of that in the future?
Well, this to me is the key question. Their comparable sales missing estimates as they come out with their EPS basically in line. How much is this going to be the status quo going forward? How much is this specific, the big ticket items that Home Depot sells, like the aluminum and steel filled items that you have in your home? How much is this tied to the housing cycle, which has been in a world of hurt and kind of on its own planet? And how much is this really the question of who is going to bear the brunt of the costs? Is it going to be the consumer, or is it going to be the companies? So far, it has been the companies. A lot of people saying that's not for long.
Home Depot in the pre-market, little change, just about positive by about 0.1%. Coming up this hour, we'll catch up with Brian Levitt of Invesco. As stocks go 2 days without gains, we'll speak to the retired Lieutenant General Robert Walsh of Academy Securities following Zelensky's visit to the White House, and John Lovelo of UBS on the state of the U.S. housing market. We begin this hour with stocks steady as retail earnings ramp up. Brian Levitt of Invesco writing, the rising prices of tariff-impacted goods, in our view, should be seen as a one-time price shock rather than the onset of a prolonged inflationary trend. Brian joins us now for more. Brian, good morning.
Good morning. Nice to see you.
Let's get into it. What gives you that confidence?
Well, we saw it in 2018. Obviously, the tariffs were not as broad back then, but you saw a one-time price jump in tariff-impacted goods while all other core goods services didn't do much of anything. So that would be one. The second is, if you're looking at the inflation expectations in the bond market, 3 years out, 5 years out on the break-evens, very stable. So the bond market is not overly concerned about it. I would still categorize it more as a price shock, and it's something that's going to weigh on demand in other places, which really should prevent a broad-based inflation spiral from taking hold.
This is the commentary that's coming from Home Depot this morning, that our customers are telling us they're putting projects on hold. They're not cancelling them. We've had this conversation over the last several months with regards to banks and activity. Are we seeing activity delayed or derailed because of the policy initiatives of the last several months?
Well, it sounds like we're seeing it delayed, but the reality is we were always going to have a bit of a slowdown here. And whether that's a slowing job market, whether that is less stimulus coming into the system. The reality was the consumer was going to slow. What's interesting this time is the housing market and housing investment have been weaker. We know that investment in artificial intelligence and the infrastructure around that has been stronger. So it's a bit of a different cycle than we're used to. But the reality is, if you look at the sort of the canaries in the coal mine for the cycle, the things that would give you cause for concern, whether it's, like I already mentioned, inflation expectations blowing out or credit spreads blowing out or the bankers tightening lending standards, none of that is evidence. So it doesn't feel like the end of a cycle. It's a slowdown, given what's been a mixed policy response reaction this year.
So that's the sort of slowdown on the demand side. There's a real question about how inflationary this is going to be. Also, digging into this, Home Depot talking about how they've been able to hold prices where they are because they brought in most of their inventory ahead of this. This is the classic story. One of their competitors said the same thing, but that this will change, that prices will have to go up, and this is what people expect. Do you still expect to see the brunt of the inflationary impact to come, that we haven't necessarily seen it yet in the inflation data?
Yeah, absolutely, and that's going to be the challenge. Like, we're going to be sitting here each month on inflation day, and the numbers are going to be ticking higher. The question is whether that is sustained or whether a year from now that moves back into the comfort zone. Now, price levels will be higher, but will the rate of change continue? It's like if my washing machine cost me $100 last year and now it's going to be $110. Right, that's a big inflation move in the short term. Next year, is it still going to be 110? Probably. So the consumer slows down, but the rate of change of inflation will jump and then likely come back down towards the upper end of the Fed's comfort zone. And that's what I keep saying. In every cycle, there's something new to watch, right? In 2008, we stared at interbank lending rates. 2020, we looked at social mobility indicators. This year, I'm laser focused on inflation expectations, 3-year, 5-year, quite stable, which is promising for how the Fed's going to approach this and promising, in my opinion, for the markets.
Is the pain trade still higher, given that there is potential downside risk, but people are concerned about inflation? People are concerned about all of these sort of more tail risks coming to the fore that could temper some of the enthusiasm.
Well, you could temper some enthusiasm, but the reality is it doesn't feel like the end of the business cycle or feel like the end of the market cycle. So it really depends on how tactical you want to be. When we look at leading indicators of the economy, it suggests to us in most places of the world that you're below trend and really mixed, but most sort of deteriorating, maybe a little bit of improvements in Europe. So it's not in a broad risk-taking environment. It's still sort of that focus on quality, focus on mega cap. The hope and the expectation is you will get some easing in here and you will get a reacceleration of activity. But we're a little bit delayed on that because we're still waiting to see what tariffs will mean.
Is that reacceleration dependent on an easing of Federal Reserve interest rates?
Yeah, I think it will be dependent on it.
Is there a risk that's derailed by the data we get in the next few weeks?
Yeah, absolutely. And so the reality on rates is I'm not as concerned as I think a lot of people are, whether it's September or which month it is. I'm more concerned about the ultimate direction of it. So, I'm not trying to time, is there a 5 to 10% downturn coming? Because in most years, you're going to get one of those, even though we already had our 20. But policy uncertainty will create that type of volatility. What I'm looking for is does the cycle continue? Will we move into a more easier environment over the next year? And ultimately, that should be a positive for risk assets.
They've got an easing bias. And so long as they've got a bias to ease, you've got a bias to buy. Is that fair?
Yeah, that's fair. I don't want to fight the central bank.
Do you think they'll have to fight the data in the months to come?
They will have to fight the data. I mean, that's the challenge, right? You have a price stability, full employment, and we know the economy's slowing. We know the job market is slowing. At the same time, we know prices are going to increase. That's why it's so critical to determine, is it a price shock or is it longer-term inflation? Again, the bond market's telling us it believes it's a price shock. Right, if I have a 3-year inflation break even at 2.5% or under, to me, that's price stability. And that means the Federal Reserve is going to work on normalizing the yield curve, getting rates back to, on the Fed funds rate closer to 2-year or, somewhere in the mid-3s to create a spread between that and the 10-year Treasury rate.
So later this week, when we hear from Fed Chair Jay Powell, he's going to reassess the framework. And a lot of people are saying it's sort of a signaling tool to markets about how they look at inflation, how they look at their dual mandate. One speculation is they will move to not just average inflation targeting of 2%, but possibly a range, right? 2 to 3%.
Right.
They might actually codify what we all have experienced in reality for the past 5 years. Does that shift your view in terms of the risk reward of stocks versus bonds? In other words, that might be good for stocks, but not so great for bonds going forward.
I do think it is good for stocks. And, if you remember, we all remember 2010 through 2019. We could not get inflation into the comfort zone. And coming into this year, we had inflation stable in the high 2s. I was thrilled with that, right? That's a great nominal growth backdrop. I don't think the Fed has to bring it to 2%. That's stability in my mind. So I've always categorized it as a perceived range rather than we have to get back to 2%, as if there's something magical about 2%. So, yeah, I do think that is good for the equity markets. I don't believe that we're going to see the Treasury market sell off significantly in that environment. I mean, you have a 10-year rate that's been between 4.25% and 4.5% now for some time, and that's probably a pretty reasonable expectation of what nominal growth or a potential nominal growth should be in the United States.
Going forward, let's say there is some sort of agreement between, and I'm just shifting gears here, when we talk about the U.S. versus the rest of the world, let's say there is some sort of peace reached between Ukraine and Russia and a rebuilding of Ukraine. How much does that actually endorse the idea of going to Europe or going outside of the U.S., or is this still mainly a United States story?
I don't think it's mainly a United States story. I would think about it more from the perspective of our U.S. rates and the U.S. growth differentials narrowing with the rest of the world rather than necessarily a deal between Ukraine and Russia. The markets have not seemed to be overly impacted by it. In fact, I looked recently, I think MSCI Poland has been one of the best indices over the last few years since Russia went into Ukraine. I don't think most people would have expected that. Not for nothing, MSCI Israel has been one of the best performing markets over the last couple of years. So I don't tend to put too much concern or too much optimism into the geopolitical. What I do think the big story is with Europe, as other people have mentioned, valuations are more attractive. There's big investment going on in Europe for the first time in a while, and the rate differentials between the United States and the rest of the world may finally start to narrow if the Federal Reserve eases here.
Really encouraging news, though. It looks like a breakthrough in the last 24 hours. I've got no idea where this ends up, but it's sort of what happens next. Do trade relations with the Russians and the Europeans normalize in any way, shape or form? Does that unlock some cheaper energy for the Europeans who've been starved of it over the last 2-3 years? And that would certainly help the European economy if that was the case. But again, I've got no idea what happens from here and whether the Europeans even want to do that, even with a peace deal.
Yeah, you can see the oil prices, the energy prices coming down in anticipation of that. And you've seen that steadily as these discussions have gone on. And as you have Friedrich Merz of Germany coming out and saying this went a lot better than he expected. There also is the question of the rebuilding of Ukraine and all the infrastructure funding that's come around that. And you can already see people trying to prepare for funding. So, yes, there is a potential boom, but a lot of people are saying, how far off is that, given all of the details that need to be worked out here?
Every time you come in, I just think FOMO guy.
Same thing. Every time. I want to come in and just say, are you still a FOMO guy? But I don't want to become cliche.
I'm a FOMO guy. Brian Levitt of Invesco still sounds like a FOMO guy. Good to see you. Thank you, buddy. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahira Anand. Hey, Yahira.
Hi, John. We are seeing sales for Home Depot coming in shy of expectations in the latest quarter, with consumers staying away from big purchases. Consumers are still facing higher interest rates and inflation concerns. The world's largest home improvement retailer said comparable sales grew 1% in the fiscal second quarter, less than analysts had expected, but an improvement from the prior quarter. Shares are lower by 1.8% in the pre-market. Meanwhile, President Trump is pushing for a one-on-one summit between Ukraine's President Zelensky and Russia's President Putin to discuss terms that could bring an end to the war. Trump urged Putin to consider the plans after European leaders joined Zelensky at the White House yesterday. The summit would be followed by a trilateral gathering involving President Trump. Meanwhile, we are seeing shares of Intel rising 6% in the pre-market after SoftBank agreed to buy $2 billion of the chipmaker's stock. The news coming as the U.S. government looks to take a stake in the company. Sources telling us here at Bloomberg the Trump administration could take a 10% stake in Intel using funds from the CHIPS Act. That's your Bloomberg Brief. John?
More on that story later this morning. Yahara, thanks for that. Up next on the program, a breakthrough in Washington.
We had very good conversation with President Trump.
I really want to thank you, President of the United States, dear Donald, for the fact that you, as I said before, broke the deadlock.
So far, nobody's been able to bring it to this point, so I thank you for that.
A conversation up next with the retired Lieutenant General Robert Walsh of Academy Securities. Live from New York City this morning. Good morning. Coming up later on this morning, don't miss this one, and one of the big dissents of the last month or so on the FOMC. Mickey Bowman, Federal Reserve Governor, sitting down with Michael McKee in Jackson Hole, Wyoming, 10 a.m. Eastern Time, together with Governor Waller. Some of the biggest dissent we've seen on the Board of Governors going back several decades.
Yeah, going into Jackson Hole, where suddenly there needs to be a new framework review. How much do we hear from the Mickey Bowmans and the Chris Wallers as we hear the political intrigue, but also the pressure on the Federal Reserve to take a stance on an increasingly fraught debate on Wall Street?
Looking forward to that conversation later on this morning, just a few hours away. At the moment, your price action shaping up as follows. We're negative 0.1% on the S&P, down a similar amount on the Nasdaq 100. Over in Europe, a rally underway across the continent. Under surveillance this morning, a breakthrough in Washington.
We had very good conversation with President Trump. It was really good. And we spoke about very sensitive points.
I really want to thank you, President of the United States, dear Donald. As I said before, broke the deadlock.
Thank you, Mr. President, for organizing this meeting and for your commitment.
So something is changing, something has changed thanks to you.
And so far, nobody's been able to bring it to this point, so I thank you for that.
So here's the latest this morning. European leaders praising President Donald Trump during Ukraine talks at the White House. The president now pushing for a meeting between the Ukrainian President Volodymyr Zelensky and the Russian leader Vladimir Putin. Bloomberg's Ollie Crook joins us now for more. So Ollie, the language used there. Here's Alexander Stubb, the Finnish president. In the last 2 weeks, we've made more progress than in 3.5 years. Is that just flattery, or is there a real shift underway?
Listen, I think there is certainly a dose of flattery there. I mean, if you could count the number of thank yous that were received around the table, it would be really sort of ranking them at a very, very high number. And this is something, of course, that was learned, in the hard way in February of last year when President Zelensky was asked if he'd ever, thanked the United States. But I do think there has been a significant shift now that is underway, and it has to do with the security guarantees, these Article 5 style guarantees that the United States, and this has been confirmed now by Donald Trump. We were just going off of sort of Steve Witkoff into Monday. Trump is saying that he's committed in some way to this new security architecture. Now, there are still a lot of questions about what this could actually compose. Would the U.S. really do a NATO-style backing for Ukraine if Russia were to reimpose itself on Ukrainian sovereignty? Would the United States get militarily directly involved? It's hard to imagine such a scenario. It's hard to imagine Russia accepting such a scenario. And there's, of course, the difficult questions about boots on the ground for the Europeans. We've spoken to a number of countries. Some countries are more open to it. We've heard from the likes of France and the UK when this idea was first floated. But when I've spoken to German officials throughout the last few months, and Germany has been the biggest financial supporter of Ukraine within Europe, they have been very, very resistant to signing on to this. So while the Europeans showed up in Washington, D.C. with a united front, that is papering over some very difficult discussions that need to still happen at home about how to pay for this, but also whether or not they're going to put boots on the ground potentially in order to have a peacekeeping troop. But I think that really the takeaway here is that at the U.S. level, at the very top level in Europe and the United States, this architecture, this new security guarantee architecture is now being built.
Ollie Crook with the latest out of Brussels. Ollie, thank you. Joining us now to build on the conversation, retired Lieutenant General Robert Walsh of Academy Securities. Lieutenant General, welcome back to the program, sir. We've been tracking the diplomatic effort in the United States, in Alaska, then down in Washington. Can you tell us what the realities are of this conflict on the ground?
Yeah, thank you, John. This war's been going on, obviously, for a long time. And when we talk about a stalemate, Russia's been making slow progress on the ground. There's no question about that. It's a much larger country. It has a lot more military power, but it's been very slow progress. And the real challenge for Russia is in today's modern warfare, the defense is more to an advantage than the offense. And Russia is running into that against the Ukraine belts of defense. And what we see clearly here is they're getting closer to the Ukrainian main defensive belts, or their fortified belts. That's the area of the Donetsk region that Russia really would like to get their hands on for a number of reasons. It's part of the industrialized area of Donetsk. It's got a lot of key minerals that are in that area. But from a military standpoint, and that's where Putin is really focused, from a military standpoint, it has the key defensive areas around 4 major cities, and urban conflict, as military members know, is the toughest warfare to go through, and that's where Russia or Ukraine has their forces entrenched in this defensive belt.
Lieutenant General, how much of a win then is it for Vladimir Putin to not have a ceasefire as some of the details of this potential trilateral meeting take place?
Yeah, that's a great question, Lisa. I think both the U.S. and the Europeans did want a ceasefire. In the situation is the Europeans and Ukraine, certainly in the U.S., would like to end the war more than Vladimir Putin would like to end the war. So a ceasefire helps end the war, stop the fighting right now, and stop the killing, as Donald Trump has put out. In the case of Putin, he would like to just continue. So these talks, he continues to kind of slowly drag out because he wants these battlefield gains. The more gains he gets on the battlefield, the more leverage he has, and the possibility of a breakthrough that could happen. And he could even gain more gains and threaten more of the heart or the interior of Ukraine.
As we hear more about security guarantees and some sort of agreement between the U.S. and Europe to guarantee some sort of support to Ukraine, do you feel more encouraged or less encouraged? Do you still kind of feel like the jury's out?
No, I think very encouraged after what's happened over the last few weeks. There's no question that the meeting yesterday at the White House was historic. I don't think we've ever seen that many national leaders, along with the leader from the EU and the NATO secretary. We haven't seen anything like that at the White House. What that really shows is the power, the unity, the strength that NATO is bringing, and the ability to kind of coalesce power for collective security. And that's a key thing here, that Vladimir Putin throughout this conflict has tried to break the NATO alliance, tried to break the U.S. from NATO. And if anything, what this showed around that table yesterday is those leaders, as Ali had said, have really kind of come around the table to show Putin that there is a lot of strength here. And it's not only military strength that's here. We know Russia has continued their wartime economy to build their military, but the economic strength that you see from the group that was around the table, it is much larger than Russia is, and Putin knows that.
Lieutenant General, just a final question. You mentioned NATO. The details of this security agreement, in your opinion, why does it need to live outside of NATO? Why is that so important? And what does that tell you about really the nature and strength of that overall agreement in the future?
Yeah, John, this is a great question. I think the key thing is if you look at Putin's objective from the very beginning, is to rebuild the former Soviet Union and break NATO. That's his goal. That's his objective. And a red line for him from the very, very beginning was Ukraine not joining NATO. And from the beginning, President Trump, as he came into office, laid that down, that he knew that would be a red line, and took that off the table, and the Europeans supported that. And so now when you get to some type of security measures, it is so important to have security measures that when the fighting stops, that there are security guarantees. And that is going to be the devil in the details as we go forward. And Putin will not want to have an Article 5 type security arrangement. And what that means is that we would be supporting Ukraine through the European countries, those that are in NATO, with the same type of support that they would get as if Ukraine was in NATO. It was a very interesting approach that Trump took and pulled that out of his hat. And Vladimir Putin listened to that and initially said he would take a hard look at that. So I think that is going to be the key thing. And Zelensky is going to push very, very hard to get those type of assurances from the large militaries
it's
of
the breakthrough
NATO and
we all wanted to see, sir. Lieutenant General, we appreciate your time. Live from New York City, welcome to the program. Here's the price actions. 2 straight days without gains on the S&P 500. A mild pullback on Friday. A very snoozy summer Monday to kick off the trading week. And it continues into Tuesday. We're down just 0.1% on the S&P. On the Nasdaq 100, negative by 0.08%. In the bond market, things are starting to get very interesting. The difference between 2s and 30s, the steepest going back to something like 2022. This morning, you're seeing it again. Yields down at the front end, up at the long end, creeping back towards 5% on 30s, 491.93. How many times have we seen this over the past few weeks?
Well, this, to me, sets up the ultimate conundrum for Jackson Hole. How much can the Federal Reserve lean into the idea of rate cuts while keeping yields in the long end suppressed? It just keep harkening back to last year. They cut 100 basis points, and they saw the long end rise by 100 basis points when it comes to yields. So do they see the same kind of dynamic this time around if there still is this kind of inflationary pressure?
I say you're seeing it again, maybe not this morning, but in the last 24 hours, and certainly worldwide as well. It's the UK. It's Japan. We're talking about multi-decade highs on bond yields at or close to those levels. Likewise in Europe, multi-year highs in some of those bond markets too. And this is the problem for the Federal Reserve and other officials at the moment. It's not just stateside, it's worldwide.
Is it a supply side story, the question of incurring more debt, which we do see around the world? Or is it a demand side story at a time where you do have inflation that is coming on the heels of supply chain disruptions, tariffs, as well as just a structural shift that we've seen post-pandemic? And that ultimately is going to be a key question.
We will keep tracking that story for you. We'll come back to it later. We'll catch up with Priya Misra of JP Morgan in the next hour. Let's get you some movers. We're about 3 hours away from the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. About 30 minutes ago, we got Home Depot earnings dropping. It was a miss on their second quarter comparable sales, up 1%. The expectation was for just under 1.4%. The CFO speaking with Bloomberg saying that purchasers are holding back on big ticket items. Yes, there was an uptick in some of the smaller ones, but that pain is apparent. They also front ran a lot of the tariffs, and they said prices will start to go up in the second half of the year, but they are going to try to keep things competitive. In other words, margin pressure. Elsewhere, we also had quite the 24 hours for Intel. For one, Bloomberg reporting that the Trump administration is weighing a 10% stake in the company. And for two, SoftBank announcing that they are buying a $2 billion stake in the company. All a vote of confidence in getting that turnaround happening at Intel, making it a homegrown champion for chip development. Shares are up 6%. Finally, another earnings for you. After the bell yesterday, we learned Palo Alto's future, and it is a brighter than expected 2026. They are trying to push a lot of their AI-enabled cybersecurity products and moreover just having a wide platform for consumers. That strategy seems to be working, so those shares up 6.5%, John.
Danny, thank you. More from Danny in the next hour. On our radar this morning, our top story, President Donald Trump urging Russia's Vladimir Putin to make plans to meet with Ukrainian President Volodymyr Zelensky. Trump proposing a trilateral meeting involving all three leaders as a follow-up. Elsewhere, Nvidia is said to be developing an AI chip specifically for China. Reuters reporting the new chip will be more powerful than the H20 model, with the company aiming to deliver samples for testing as soon as next month.
To me, this is the true test of how much President Trump's administration has bought into the Jensen Huang view of the world, which is that it is more important to have a presence in the technological footprint of China's AI machine than to avoid selling them higher caliber technology to potentially hamper their march toward AI supremacy. It highlights how the sort of Belt and Road question of technology has really permeated this White House. So the key issue is, will they sign off on this? Will they allow NVIDIA to sell this chip? And if they do, it indicates a very different way of looking at U.S. technology and what kind of safeguards need to be on it going into China.
Most people would assume yes, with the price. Yes, if you give us a share of the revenue, which is where we're at right now.
Which actually, and I'm just going to be really honest, doesn't make any sense to me on a theoretical level, because I don't understand how that has to do with national security, and I don't understand how to sort of expand that into a framework of where our priorities are. But at the same time, if it brings revenues in, then, S&P will be happy.
S&P Global very happy with some of the revenue coming in. We'll talk about that a little bit later this morning. The tariff revenue. NVIDIA's up in the pre-market by a few tenths of 1%. Let's finish on trade. President Donald Trump expanding the list of products subject to 50% steel and aluminum tariffs. More than 400 consumer items that contain the metals are now included, such as motorcycles and tableware. And as I read that story, I'm just thinking, you know what? I looked at that this morning and just thought, this is still going to take time. If you're drawing conclusions about tariff pass-through sitting here in the middle of August, Tell me what you're thinking a month from now, 2, 3, 4, 5 months from now, because the tariff pass-through is going to take some time, given that the tariff policy is changing too.
Tariff policy is changing, and where people get their steel is changing. U.S. Steel is very happy about this, and you saw some of the lobbyists come out very excited. Meanwhile, the S&P and others out there are saying, yay, it's going to bring in revenues, an estimated $138 billion of revenue with imported duties. It really points a spotlight to Home Depot and them talking about how they front ran a lot of the tariffs. They brought in a lot of the goods, so they haven't had to pass along the prices. How much does that change as this does go on and during highly fungible policies when it comes to what tariffs are put where?
Let's get to Home Depot right now. Shares slightly under pressure this morning. Shoppers pulling back on big ticket items. That stock is down by 1.2%. Bloomberg's Drew Redding joins us now for more. So, Drew, what's the latest read of what's happening in U.S. retail?
Yeah, so when you think about Home Depot, you have to think about who their consumer is. A majority of them are homeowners, as you would expect, typically dual income households, higher income earners. They're seeing strong employment, strong wage gains. So, they're still spending. I think what you need to look at, and what you guys alluded to earlier, is where people and how people are spending. We're seeing relative strength in smaller ticket categories. But where the weakness has been is in those bigger ticket discretionary categories. And this is something that's been going on for several quarters now for Home Depot. And the reason for that is because rates are so high. If you think about the type of projects that are typically financed, like kitchens, baths, flooring, with rates where they are, consumers are taking a wait and see approach because they think rates are going to fall. So they're delaying these projects. And that's really where the weakness has been.
So, Drew, this is an important tape because we're all trying to figure out the answer to the same question. Are we seeing activity delayed or derailed? Do you sense that once we get a few rate cuts in the pipeline from this Federal Reserve over the next several months, it will unlock some real activity?
Yeah, I think it's more of a project deferral situation. Homeowners have certain projects that they need to undertake. They need to do them immediately. And then there's the discretionary categories, like we mentioned, which are more subject to that financing. I think if rates start to come in and you start to get a little more activity from a volume perspective in the housing market, I think that really starts to boost those demand for big ticket projects. And the way Home Depot and even Lowe's has been positioning themselves over the last couple of years is to capitalize on those big ticket projects with professional contractors as that demand starts to reemerge.
Drew, appreciate the update. Drew Redding there of Bloomberg, the latest on Home Depot and the latest on people making a push to maybe renovate their kitchens.
Yeah. Well, some people are getting ahead of the rush later and redoing their kitchens now and actually find that people are pretty available.
Share your story. How's that going? What's that like? Access to labor?
Access to labor, it actually has been a lot
Are the deals
better.
as well?
Yeah, and I think I think within reason, but people have imported the goods already, and so you don't have to pay the tariff prices. So some people theoretically thought, let's get ahead of this because the rush for it will happen later. So if you do it now, the prices won't have gone up, and so far it seems to be working.
Abramo making a move. Home Depot down by a little more than 1% in the pre-market. Let's stick with housing. Building permits and housing starts data coming out at 8:30 Eastern Time. We'll get some earnings too. Results from Toll Brothers after the closing bell. John Lovell of UBS writing, we expect another solid quarter from Toll Brothers, most notably in terms of deliveries and margins, while orders could be a touch soft. John joins us now for more. John, good morning.
Good morning.
The bounce is finally happening in home building stocks. I'll throw that out there first. Why have people suddenly woken up to all of this over the last few months or so?
So let's put it into context. So since the start of earnings season, the builder stocks are up about 17% relative to the market being up about 2%. This is something we highlighted in our preview note, and we titled it Bear Trap. And what we meant by that is that it felt like investor sentiment had turned far too negative at a point where consumer confidence was beginning to improve. And most importantly, we were approaching the end of the negative earnings revision cycle. And that's a very powerful point to get involved in sort of cyclical early cycle stocks. And so I think what we're seeing is sort of the culmination of the consumer kind of settling in, rate stabilizing, and people realizing, hey, you know what? We may be very close to the bottom.
Rate stabilizing. That's a nice way of saying on the precipice of rate cuts. How much is this predicated on the idea that the Fed is going to embark on 100, 150 basis points of rate cuts over the next 18 months?
Lisa, I don't think we need it. We're at 6.59 on the 30-year. That's not a bad spot to be. I would take lower rates all day long, But stable rates are what we really need. And what that means is that the consumer has an idea of what they're getting into. Importantly, the companies can plan their businesses. They can kind of plan the mortgage rate buydowns. The cost of those buydowns comes down with rate stabilization as well.
I'm so sorry, but I'm thinking here, we don't need lower rates. What is we here? Are you talking about the home builders, right? Because there are a lot of people who are screaming at their screens right now saying, we really could use lower rates, and home affordability has been the lowest that it's been in decades and generations. So you're telling us we don't need it. Are you just talking about home builder profitability, or are you talking about the housing market as a whole to actually generate some type of volume and normalcy?
It's an interesting question, right? And I would say that there's two sort of distinct markets out there today, right? There's the new construction market where the home builders have the ability to buy the rates down, and they've done that very successfully. But to your point, 90% of sales historically have been on the existing home side where we do need rates to come down. And that sort of turnover in the existing home market is critical to the long-term success of the market. Think about it, when an existing home is sold, there's going to be generally a purchase on the other end. That could be a new home or an existing home. But this part of the market being frozen is not good for anyone. So lower rates to that extent are important.
You like Toll Brothers. It's a very different market.
Yeah.
So spell out why you like Toll Brothers.
Yeah. So we've sort of taken a barbell approach where we like the entry level because that's a very need-based buyer. Life events like marriage, children, things that necessitate more space. On the other end with Toll Brothers, this is a buyer that is less concerned about rates. I mean, 30% of them pay
wealthy.
cash. Yeah,
yes.
They pay cash. But, on the flip side...
Give me that number again. What percentage pay cash?
25 to 30%.
That's for Toll Brothers?
For Toll Brothers.
Yeah.
Yeah. There's also about, over $200,000 of very high margin sort of options and upgrades that go into these homes. And so it's a different buyer. Now, Toll Brothers is not just this high-end buyer. Keep in mind that their ASP is about $1 million, but they span from, called $400,000 up to $4 million. And so it's a very wide range. And they've actually changed the business model to the extent where about 50% of their deliveries are on spec. And what we mean by that is they're starting the production of the home before there's that buyer in place, which helps them expedite the build cycle.
Can we deal with some of the doom and gloom? I'll throw it out there. Lisa will weigh in. No doubt she'll double down.
Lisa will definitely weigh in.
Without a doubt, she'll double down.
I'm not that bearish. I'm redoing my kitchen.
Abramowicz, let's talk about housing. You've seen the same charts I have. The amount of unsold inventory. We've heard a lot of people say this is a market now that's priced for rates at 3%, not 6%, and it's not sustainable, it's going to break. What would you say back?
Yeah, I think, look, there are certain markets where inventory has clearly built up more than what the builders would like to see. I mean, there's parts of Florida, the I-4 corridor between Orlando and Tampa, parts of Texas and Austin, even in Phoenix. But now what you're going to see today with the housing starts is that the builders have done the very rational thing, and they've pulled back. They said, look, we're not going to push inventory into a market that is just not receptive. And what that's going to do, very importantly, is clear the path as we move to the back half of this year and into next year from an inventory standpoint.
A lot of people say that unless rates come down significantly, prices have to come down 10 to 15% around the country in order to normalize the housing supply. Do you push back against that?
Absolutely. Yeah, I think we're still underbuilt massively in the U.S., particularly at the price points that are most important for today's buyer, and that's the entry-level, first-time kind of buyer space. There's just not enough inventory. I find it very hard to believe that we'll see widespread declines in pricing. Keep in mind that we have about 1.8 million units of single-family inventory in the market today. That's below the historical average of 2.4 by about a standard deviation. So we are still light on inventory across the board, particularly at the price points that matter the most.
John, it's good to see you. It's good to catch up.
Thanks
good rallying those names that you cover too. It's finally happened.
Yeah.
John, thank you, sir. John Loveller there of UBS on the home builders here in the United States. This is one of the most sensitive topics in US politics right now, particularly in this city.
What he just said right now explains why Zoran Mamdani is running and why so many people have really backed him. This is such a political hot potato because ultimately housing prices where they are has really made it so that a lot of people in a certain generation, unless their parents are very wealthy, cannot afford to get in on the housing market. What's the solution to build more, right? And this is what people keep saying. How do you get to that place really is going to be a key question.
The average age of the first-time buyer, we've all seen the chart. It's just doing that.
Yeah,
That's
exactly.
not the chart you want to see.
This to never. And that's sort of what we're talking about at a time when it really has to come down to inventory.
I like that. Up and to the right to never. You know, something like that. Right?
That's kind of what it is.
Yeah. Well, I don't like what I see, but I like the expression. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. The union representing Air Canada's flight attendants said the strike has ended after a tentative agreement has been reached. The union advises its members to fully cooperate with resumption of operations. Air Canada's flight attendants walked off the job on Saturday after contract talks with the carrier had failed. Flights are set to resume this evening. Meanwhile, Apple is expanding its iPhone production in India ahead of the debut of the iPhone 17 next month. Sources telling us here at Bloomberg, Apple plans to produce all 4 models in India, marking the first time that all new variations will ship from the country. This comes as Apple seeks to lessen its reliance on China for U.S.-bound models. And Hurricane Erin is threatening to cause big problems in the U.S. While the Category 3 storm is not expected to make landfall, it is raising the risk of high winds and flooding along the Carolina coast. Dangerous rip currents and flooding are also expected in other states, including Florida and north to New York. Waves may crest more than 20 feet on Long Island this Thursday and Friday, according to officials. That's your Bloomberg Brief. John?
We'll be tracking that. Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, a slowing economy.
The economy's slower than people think. I think all those job revisions, we're finally starting to realize, hey, this economy's slower. There's pressure on the consumer. I think the global economy's slowing.
That's next with Kit Jukes of SocGen, live from New York City. You're watching Bloomberg TV. Live from New York City this morning. Good morning to you all. Under surveillance this morning, a slowing economy.
The economy's slower than people think. I think all those job revisions, we're finally starting to realize, hey, this economy's slower. There's pressure on the consumer. I think the global economy's slowing. The markets are a little bit potentially in danger of getting too comfortable that we get rate cuts for good reasons.
So here's the latest this morning. The strength of the U.S. economy in focus as investors await Fed Chair Jay Powell's Jackson Hole speech. Kit Jukes of SocGen writing, the more prices rise in the data, the worse it will be for the economy. And the Fed should focus more on the labor market as a result. If they do that, the dollar will be vulnerable. Kit joins us now for more. Kit, welcome to the program, sir. Let's talk about this FX market, driven in the first half of this year by perceived capital flows. Do you believe that in the second half of this year, it will be driven by rate differentials, and why?
Rate differentials up to a point, expectations about growth, which are often the same thing. But yes, I think but people are genuinely uncertain in the sense of at the moment they're uncertain, but aware of the fact that the world is very long dollars because we've all put so much money into the U.S. equity market, because money's gone into the U.S. Treasury market, because the U.S. has been outperforming for so long, and that if the economy slows, rates need to come down significantly. Then some of the returns people have enjoyed are pretty vulnerable. I think the market's confused about the short-term rate story, but confident that the answer is the U.S. economy slowing a little, or is it in more danger of a more significant slowdown? And that means we're overreacting to every single piece of macroeconomic data, with the exception perhaps of the really sort of minor data we saw yesterday. But we're lining up to overreact to each piece we get going into September.
Taking a step back, Kid, earlier this year, it seemed like a one-way freight train of sell dollar, sell the United States. That was the trade, and pretty much everyone lined up behind it. Is it over? We've kind of plateaued and kind of shifted around this level for a couple of months now. Are we seeing sort of the end of the sell the America trade and going back to this sort of nuanced, overreacting to every data point type of landscape?
I think the data will decide that. I think the question then is whether the U.S. economy is slowing significantly. I mean, a currency can't go down as fast as the dollar did or go up as fast as currencies like the euro did for very long. An inflation-targeting central bank reacts to fast currency moves. An economy reacts to fast currency moves. So the move we had in euro dollar from 102 up to 118 was too fast. We have to take time out. Whether that takes us to 125 or we get stuck here depends on how much or how little the U.S. economy slows in the next 3 months, I would have said. And if we got a repeat of last month's payroll numbers, if we got something genuinely soft, then I think we're going to head off into the middle of the 120s for euro dollar. We've got another 5 to 10% weakness in the dollar in this cycle to come. But you know, I wouldn't want to overinterpret some of the data that we've had in the summer and extrapolate it out blindly as saying that is what's definitely going to happen. Again, if the inflation hit from tariffs isn't too big, the economy's not going to slow too much, and a very gentle easing in US growth doesn't justify much dollar weakness at all.
So let's build on that. Right now we're looking at 116.88 on the euro dollar cross. You're saying it could go into the mid 120s if you do see some sort of significant weakening in the US economy. Heading into the fall, what are the key data points that you're looking at, and what would constitute that type of weakness that would really cause that type of depreciation in the dollar?
So we would set ourselves on that route if we saw weakness that suggested not recession or anything, but that the Fed's got significant rate cuts to make, that we're going to get yields down, that the things that have made people pour their money into US assets need to be questioned at least temporarily. So if we saw a payroll number in the United States that was, I don't know, say only up 100,000 or weaker than that at the beginning of September, I think that would concern people. If you saw weakness in the housing market beyond a small correction, if you saw softness in real personal spending as consumers scale back in the face of higher prices, then I think you'd be sort of forming that kind of backdrop. The advantage for the consumer who's critical in this is if the inflation data continues to be held back by lower energy prices. So if low energy prices offset tariff increases, or if tariff increases aren't fed through to US consumers, it all softens the economic blow and the downside to the dollar is reduced.
Kit, we're all still wrestling with this, and I imagine many on the committee of the Federal Reserve are wrestling with the very same thing, which begs the question going into Jackson Hole, just how much can we expect? Neil Dutta, Renmac, don't expect a strong signal at Jackson Hole. Jonathan Pingler, UBS, if you're looking for rate cuts, he says, quote, I don't think he's going to lock it in. Kit, do you think he's going to lock it in a few days' time?
I'd be surprised if he locks it in, but the topic of the symposium is the labour market. The labour market is going to be the thing that tells us what's happened to the economy. So we should hear a really interesting set of discussions about how they feel about the labour market and how they feel about labour market tightness relative to softness in employment gains. And if I get any hints from that, I will jump on them to provide me with a clue to what they'll do. But I think that, again, if the jobs numbers are weak at the beginning of September after what we saw last month, frankly, the game's up. So that'll tell us what happens. But it'll be a very interesting symposium on the labour market.
Okay, just before you go, what's more likely over the next 12 months or so, that we get 3, 4, 5 rate cuts from the Federal Reserve, or Arsenal win the league?
3, 4, 5. Yeah, I think Arsenal have got a decent chance of winning the league. I'm slightly more optimistic about that than about anything in the US economy, which is all up for grabs.
Kit, thank you, sir. Kit Jukes there of SocGen. Kit, thank you very much. On the FX market and a little bit of Premier League football.
Yeah, they just beat Arsenal. Arsenal just beat Man United. It was a really great game. 1 goal.
You enjoyed that?
It was really good, yeah.
Calafiore.
Yeah, exactly.
At the far post.
I think that actually they're doing really well. So
I know you actually watched this too.
I do. I'm starting to. It's sort of ironic that, maybe golf will be next, who knows?
Maybe.
Yeah,
Speaking to someone yesterday, found golf very relaxing. They don't play themselves. They just like watching it.
Yeah, it's the
just
relaxing
the rhythm,
thing. Yeah, exactly.
The cadence of it all.
I prefer staring at the wall.
Tour Championship this weekend. Just give it a go. Just give it a go. All right. And sometimes a raw.
Yeah.
All right. Up next on the programme, Sarah Hunt of Alpine Saxon Woods, Brian Gardner of Stifel, Angelo Zena of CFRA, and the brilliant Priya Misra on the bond market, joining us from JP Morgan.
If the labor market deteriorates further, then the Fed can get more aggressive.
It's clear from the recent data, particularly employment data, that we have a dual mandate that is in conflict.
You're going to have to cut. You're moving in that direction.
There's enough to start the process of cuts, but not necessarily enough to commit to, 150 basis points of rate cuts.
Why would policy be restrictive at a time when there is so much uncertainty?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. It has been a snoozy couple of days. Snoozy Monday, and pretty quiet this morning too. We're down by 0.1% on the S&P 500, negative by 0.13 on the Nasdaq 100. In the pre-market, one name to watch, Home Depot. Out with earnings a little bit earlier on this morning. Tomorrow we'll hear from Target, the day after from Walmart. That name is down by, let's call it 0.7%, out with numbers about 60 minutes ago. Just a little bit softer than expected.
What's most interesting to me about Home Depot is delayed, not deferred, right? This idea that people still have their projects, the big projects in the works, but they don't have the conviction to go through with them. The other interesting aspect, and this speaks to the question of how inflationary will tariffs ultimately be, they talk about not passing along prices yet. That is because they brought in a lot of the goods ahead of some of the tariffs. Going forward, they do expect to pass on some of the pricing. This is going to be a theme. So far, companies have eaten the tariffs. Will that change in the months going forward?
They're in a fairly good position, arguably, for a couple of reasons. They secure more than 50% of their goods, I believe, from the United States of America. And as for that delay, we spoke to a couple of people in the last hour who believe once you get a reduction in interest rates, people are going to step back in and start doing these projects again.
But this ultimately goes down to the dual mandate, right? If you have rates come down, suddenly demand goes back up, and then people can increase the pricing, which goes to the question of inflation. It is the reason why you look at valuations where they are in this snoozy August, and you wonder, how much room do we have to continue upward? What will the catalyst be? Are rate cuts enough, given that we've baked them in, and given the fact that inflation has not died? And that ultimately is going to be a huge question at a time where we do see longer-term bond yields creeping higher around the world, even at a time when the Fed seems to be very much on course to cut rates.
Isn't it nice to have a snoozy August?
You know,
just like, a little bit quiet.
Yeah, well,
just settle down.
I'm just telling you right now, people will be cursing your name at the end of today when the world is erupting. You do this every single time.
Strange
there's a quiet
things
day.
happen in August.
Okay, are you actually
was it Japan last year? I feel like it was Japan last
So
August.
hold on a second. Would you like to see something strange happen?
Look, I am long volatility, sat in this seat. Obviously, I have a bias. I can share that. That is not a secret. It's more interesting to me when things are a little crazier. Get that? But I think a lot of people deserve a summer. Just take a beat, go to the beach, take a few weeks off, re-engage.
Just warning, when he says this, re-engage, start watching, things happen.
Re-engage. Maybe in the bond market. That's my focus too.
Very
Just
much
this continued bleed higher in long-end yields worldwide. And we spoke to the Treasury Secretary, Scott Bessent, about it just last week. This leakage on 30 years worldwide. We've talked a lot about that wall of demand stepping in and buying backups in yields. You don't really see that at the very long end of the curve. That's been like the orphan segment of the yield curve globally over the past 6, 7, 8, 9 months. And I think it's going to become a bigger and bigger problem for policymakers, both central bankers and fiscal officials alike.
Especially because the ballast of the bond market had been Japan, which had been stuck in this sort of morass of no growth, no inflation. Suddenly there's inflation, there's the potential for yield, and all of those investors have some sort of incentive to keep their money home. You start having yields creep up there. Around the world, it's going to be that much harder to pressure yields lower. You add on top of this inflation, the reindustrialization, this question of supply chains getting nearshored. Suddenly, it's a very different picture, and it clearly is one keeping a number of policymakers up at night.
We made it interesting. There you go. 30-year bond yields this morning, down about a basis point, very close to 5%. That 30-year yield at about 4.92. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods as stocks slip with earnings in focus. Brian Gardner of Stifel as President Trump is pushing for a meeting between Putin and Zelensky. And Angelo Zeno of CFRA as the White House is weighing a 10% stake in Intel. We begin this hour with stocks inching lower. Sarah Hunt of Alpine Saxon Woods writing, investors seem positioned for positive earnings surprises into 26, but we expect higher volatility as summer gives way to fall. Sarah joins us now for more. Good morning, Sarah.
Good morning.
It's good to see you. What's the source of that volatility going to be?
I think the uncertainty that's coming around, the timing of what's happening in tariffs, the timing, like there was an announcement today that aluminum and steel in different products was going to be taxed at a different rate, and that it did include goods in transit. I think all those kinds of things make for problems for potential earnings. I think the uncertainty around what spending is going to happen, something like what's going on with Home Depot, not such a huge thing, not a big surprise, a lot of big ticket items, not so much people bought ahead of tariffs. But I think that there is some concern about what this is going to do to margins and what it's going to do to earnings. And that's going to, I think, add to volatility.
Well, let's stay on this. Which way do you think it breaks? Let's say we've got a company right now in America that was importing a lot of goods, a lot of pre-tariff inventory of the goods they imported that were tariffed. They were absorbing that on margin. Do you believe that's going to lead to, say, cost cutting, a labour market hit, or do you believe it leads to higher prices? They're going to pass it on to the consumer.
I think they're going to try to do both. I think they're going to try to get their costs in line as much as they can, and I think they're going to try to push price to the extent that they can. And the question really is, as these targets have been moving all year, did we get such a backup in demand that we pulled for a lot of activity, and are we therefore going to see some softness anyway? Or is this going to be so gradual that it doesn't have as big an impact as a big one-day slam dunk situation? And I think that's the question, and how this plays into PPI and CPI, because a tariff isn't really inflation itself. It's a tax, but it doesn't matter, because if the price levels are moving higher, it doesn't matter. To the consumer, it feels like a problem because prices are higher.
I remember a long time ago at the end of July when people said August tends to be volatile. Watch out, it tends to be the witching month. Well, we're up, 1.7% on the S&P. We've reached new high after new high. Sure, we've been down for a couple of days, but down is sort of a relative statement given that we're going nowhere. At what point are we just pushing off this volatility, showing that the pain trade still is higher?
So I think that right now we've got Jackson Hole coming up this week. If you recall, last year it was the labor numbers in August that came in that really threw things off for the Fed, and people started to worry about the labor market. The data is uncertain enough that right now it's like it needs a push one way or the other. The fact that there is talks with Russia and Ukraine, whether they get to peace or not, that's probably a net benefit to most things except potentially energy, which is not the worst thing in the world either, because that helps everybody else with lower energy prices. I think the question's really going to be, where do we end up in terms of the consumer, and where do we end up in terms of inflation, and what happens to companies, and are they laying people off? Does that affect the labor market? All those interplays are uncertain now, and I don't know how much clarity we get in 3 or 4 weeks, but you could see some uneven data.
Right now, a number of people are talking about trying to just get a little bit more defensive. We see that in the investment grades market, with spreads getting to the lowest levels going back to 1998. And the theory here is there's going to be some weakness, and potentially you could see it in a stagflationary type of feel. Are we getting to a place where the high flyers, the tech-exposed stocks, will continue to perform even as the rest of the market continues to just kind of grind nowhere because of that type of dynamic of stagflation?
And because of the dynamic that there's still a lot of growth in that sector, there's still a lot of cash flow, and they're not being impacted as negatively as some of the companies that don't have the technology aspect. So as that technology flows through, maybe you do get some margin expansion from that, right? Because that's the big argument about AI, is that it's going to help us and it's going to help productivity, and that's going to help margins. So there's a little bit of an offset. Whether or not we get that, the big spend right now is still in technology. So those stocks are at a premium valuation for a reason, because people can see through and see forward.
At least I mentioned investment-grade credit spreads. Let's spend a couple of minutes on that. This is important. Super tight. Tightest level since when? Was it 98?
98.
This side of this century, which is absolutely bonkers. Do you think that tells you more about confidence in corporate America, or a lack of confidence in the Treasury, in the US government, and in fact for sovereigns worldwide?
I think it probably has to do more with the confidence in the companies themselves and the balance sheets of the companies themselves. I think there's a little bit of that on the sovereign side, because as debt levels rise globally, there is concern on the sovereign side that we hadn't seen prior to those massive increases in debt post the financial crisis. But if you look at the way that public companies, at least, have been managing their cash flows and balance sheets, there's a reason those spreads are so tight. One, it was a yield-chasing operation, and the other one is they're in pretty good financial shape. There isn't a lot of credit weakness on a lot of the publicly traded stuff. So the IG and those spreads are very, very narrow, because there isn't a lot of daylight between that right now.
There's another way of asking what John asked, which is, even with spreads at the narrowest since 1998, is there still value because there is any spread above benchmark government rates, given that their creditworthiness on some level might be better in some respects than the U.S. government?
I think that's one of the reasons that you saw some of those corporates be able to borrow at ridiculously low rates, right? Because people looked at them and said those stabilities of cash flow are way better than some governments that I've seen. I think in the end, there's always a place for fixed income when it has finally a yield, which it does. If you're matching portfolios, if you're matching exposure, or if you're just looking for safety and preservation of capital, there's always a space for that. And I think that right now, it's not a bad place to be if you know that you need that money in a short period of time. Longer term, do we think that rates maybe go higher in the long end? They could. It's unusual to stay this low for this long.
Are corporate bonds a better hedge right now, a better safety play than government bonds, given the fact that they also have these strong balance sheets behind them?
I think that the volatility in governments is much more policy driven than it would be for corporates. So to the extent that you might see more volatility in the government market, and we have over the last year, which is the last couple of years, it's more surprising to see that much volatility in government spreads. So to the extent that there's less vol in the IG market, I think that's not a wrong thought.
Sarah, good to see you. Thanks for dropping by. Thoughtful stuff. Sarah Hunt there of Alpine Saxon Woods. I believe it was Brian Weinstein, then at Morgan Stanley, now at Apollo. But when he was at Morgan Stanley, I think he sat around this table and we talked about the prospect of IG spreads trading through, actually seeing them go through treasuries.
And what Sarah Hunt just said there, I thought was really compelling, the idea that you could see less volatility in corporate bond yields than you could government bond yields, because they're not going to be subject to tariff announcements or some other proclamation that could have the same kind of volatility on long-term government bond yields. So maybe Apple's not the best example, maybe Microsoft spreads are going to trade inside 10-year treasury yields at some point at a theater near you.
It's pretty amazing, isn't it, that we've got the tightest spread since 98, equities at all-time highs, and we're having this conversation about a deceleration in the economy and rate cuts coming soon.
Well, this to me is the conundrum. How can we be talking about the need for more accommodation when you see record highs in a number of different risk instruments in the U.S. equity market? And you just see that the U.S. equity market and the U.S. bond market has gotten so divorced from the underlying economy that we're talking about two different things. And that continues to be a conundrum for the Fed.
Two very different worlds. S&P futures this morning negative by 0.1% on the S&P 500 with an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump is pushing for a one-on-one summit between Ukraine's President Zelensky and Russia's President Putin to discuss terms that could bring an end to the war. Trump urged Putin to consider the plans after European leaders joined Zelensky at the White House yesterday. The summit would be followed by a trilateral gathering involving President Trump. Meanwhile, sales for Home Depot coming in shy of expectations in the latest quarter, with consumers staying away from big purchases as they continue to face higher interest rates and inflation concerns. The world's largest home improvement retailer said comparable sales grew 1% in the fiscal second quarter, less than analysts had expected, but an improvement from the prior quarter. Shares are higher. Meanwhile, Nvidia shares are also edging higher, up 0.2% as the company is reportedly developing a new AI chip tentatively being called the B30A. According to Reuters, the chip would specifically be for China and would be more powerful than the H20 model. The B30A chip is likely to deliver half the raw computing power of NVIDIA's flagship B300. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira about 30 minutes away. Up next on the programme, Europe's charm offensive.
We had very good conversation with President Trump.
I really want to thank you, President of the United States, dear Donald, for the fact that you, as I said before, broke the deadlock.
So far, nobody's been able to bring it to this point, so I thank you for that.
That conversation up next with Brian Gardner of Stifel, live from New York City this morning. Good morning. Stocks are doing okay. We're down about 0.1% on the S&P, and the Nasdaq 100 softer by 0.14 on the Russell. After a brief breakout, it didn't last long. We're down about 0.16% so far this morning. Under surveillance this morning, Europe's charm offensive.
We had very good conversation with President Trump. It was really good, and we spoke about very sensitive points.
I really want to thank you, President of the United States, dear Donald. As I said before, broke the deadlock.
Thank you, Mr. President, for organizing this meeting and for your commitment.
So something is changing, something has changed thanks to you.
And so far, nobody's been able to bring it to this point, so I thank you for that.
Here's the latest this morning. President Donald Trump looking to strike a deal on security for Ukraine while pushing for a meeting between Russian President Putin and the Ukrainian leader Zelensky. Bloomberg's Ollie Crook joins us now for more. Ollie, some things change. What changed?
Yeah, I think that what has changed in the last 48 hours is going out of the sort of abstract on this idea of the security architecture after a sort of peace proposal, which of course the backstop, the Article 5 style conditions where the United States would support Ukraine in the event of a peace deal. That was basically fundamentally to getting a deal over the line. And that is something that Donald Trump himself, not just Steve Witkoff, not just Marco Rubio, said that he would be there to stand by in some capacity in terms of securing security guarantees for Ukraine in the future. Now, what that exactly means is still very much up in the air, but what the European leaders can say, and is factually true, in fact, the European leaders are meeting right now to debrief from that meeting yesterday, is that there is an architecture that is currently being worked on at the top level by the United States and the Europeans. But what I think, John, is very interesting here is that we tend to focus on selling this to the United States, this defense architecture, selling it to the Ukrainians, to a certain degree, selling it to the Russians. What we have not really talked about, and this is going to be the next task at hand, is selling it domestically here in these European capitals. These were European leaders that were very unified in Washington, D.C. They don't necessarily have that kind of rock-solid commitment and sort of unity within their own capitals. You think just of the Germans who last week, the AfD, the right-wing party in Germany, who's been very pro-Russian, very against giving more support to Ukraine, they became the #1 most popular party in Germany last week. If you're talking about potentially putting German boots on the ground within Ukraine to secure its defense in the future, that is going to be a very difficult sell politically. So there's still a conversation here in Europe that needs to happen about boots and, of course, money, because the United States is not going to pay for it.
Well, Ollie, let's talk about the money. This came from the Financial Times. They're reporting Ukraine will promise to buy $100 billion of American weapons financed by Europe in a bid to obtain U.S. guarantees for its security after a peace settlement with Russia. What are you hearing about that?
Yeah, so listen, this is going to be part of the conversation going forward, and there are a lot of different programs that are currently in place to buy a lot of these arms. There's a lot of question about, John, that almost $500 billion that the Germans are going to spend on defense. How much of that are they going to willing to put forward to ensure Ukrainian security? This is the fundamental question, John. We talk about joint debt. This is something that comes in and out of the sort of periphery and the sort of main conversation here in Brussels. It's sort of faded away. At a certain point, John, I think it's inevitable. We're going to be back at the conversation at these finance ministers' meetings like we were, 10 years ago at the sort of height of the financial crisis, talking about joint debt, because how is this going to get paid for? The Europeans do not have the military hardware. What they do have is a little bit of fiscal space, not that much of it. They're going to probably have to look at debt financing this. This is something that they did in the pandemic. It's something that's going to be reopened once again. $100 billion is a lot of money. It is money that Ukraine does not have, and the Europeans need to pull together in order to keep the United States on board.
Ollie, appreciate it. Ollie, with the latest over in Brussels. Joining us now to extend the conversation, Brian Gardner of Stifel. Brian, welcome to the programme. Let's take it from the top. What are the details, as far as you understand, of what the security arrangement might look like?
I think Ollie hit the main points, and I think the big takeaway is it still has yet to be finalized. That, yes, you do have a European financing component with U.S. selling arms to Ukraine. Big question is, in terms of the security guarantee, is boots on the ground. I mean, is this security agreement going to include NATO troops, U.S. troops? I don't think anybody knows that yet. So I guess, Jonathan, the ultimate answer to your question is that we still don't really know what the details of the agreement are. Maybe there really isn't an agreement in place. It's an agree to move forward with some kind of framework, but not a real agreement yet.
Brian, Ollie raised a really good point, this question of selling this deal, whatever it may look like, at home. And there's a real question in the United States about how much appetite there is, what type of popular support there is in furthering this effort, in putting boots on the ground from the United States, from giving any money from the United States, or potentially from not doing such actions, given some of the previous polls. What's your take on where the populace is?
So throughout the Ukraine conflict, the U.S. population, U.S. voters have pretty solidly been behind supporting Ukraine. That has slipped over time, but it's still, I think, a majority. I think most polls would show a majority of Americans supporting Ukraine. The question is boots on the ground. And this becomes not just an issue for the broader population, maybe more specifically for the Trump base, the MAGA base, which has been against forever wars. It's against U.S. international involvement. They see this as a European problem, not an American problem. This could create a big split within the Trump base. That being said, he has a unique hold over that base. So, are they going to stick with the principles that led them to back Trump, which was, kind of make America first, make America great, America first policies? Or are they going to then shift and say, he's our guy and we're going to follow him, even though this is not what we voted for?
Well,
but there is a question coming up about his support among his within his base.
Well, to build on that, Brian, I mean, this is sort of the question at a time when there are so many different domestic issues that are facing the government. Why is President Trump spending so much time with this? What is your sense of why at this moment President Trump is getting so engaged in trying to bring about the trilateral meeting?
I think it's the same answer if we were talking about tariffs, which is legacy, right? Everything that Trump is doing at this point, especially in these big issues, is about legacy. I think he knows deep down that when historians write the history of his presidency, foreign policy is going to play an outsized role in that. It always does. Going back to World War I and Wilson, World War II, the Cold War, presidents have been defined through it for the last 100 years by their foreign policy accomplishments and failures. And to bring peace to Ukraine, what he's working on in the Middle East, if he's able to accomplish this, despite all the noise about what goes on domestically in the United States, that is going to set him apart in his mind from a lot of other presidents, and that historians will be very kind to him as they write the history of his presidency.
Brian, something really big and transformative is happening to American power on the global stage. It feels like we're blending national security initiatives with commercial objectives. A colleague of mine, Steve Hu, put this out on X in the last 24 hours, Pax Americana as a service. He's being snarky, but you can see how this might play out. If you want us to be a superpower on the global stage, you're going to help pay for it, seems to be the message, Brian. How are you thinking about that change? Because that's a big shift.
Yeah, I think there's a shift internationally. I think there's a shift domestically, Jonathan. I'm probably going to get in trouble for saying this, but I don't necessarily view Donald Trump as a capitalist. I think he's more of a mercantilist. And I think your question and viewing how U.S. domestic economic policy go hand in hand, I think you can see that shift there from capitalism to mercantilism, where the state has, yes, there is private property. You can make profit, but the state is going to have more of a say in how you do that. And then on the international side, yes, we're going to help, but you're going to pay for it. I think there's a big shift both internationally and domestically going on.
Brian, we'll keep tracking it. Appreciate your time. Brian Gardner there of Stifel. In just a moment, we'll catch up with Angelo Zeno of CFRA, talking about the White House taking a 10% stake of Intel. That speaks to exactly this conversation we're having right now about national security.
Yeah, and what Brian said, which is he sees President Trump as more of a mercantilist, someone who believes in the government controlling more of a stake in terms of some of the key businesses than just allowing capitalism to run amok. And that seems to be the Intels of the world, the give us a slice of the NVIDIA chips of the world. But if you look back, a lot of different kind of republics in the past, I'm thinking at Rome, for example, controlled the trade routes and controlled these things.
Sure.
So it's not without precedent. And this is something that some of the big rivals, I'm thinking of China, do with a much more aggressive thumb.
Capitalism with Trumpian characteristics.
Exactly, I guess so.
It's kind of what this is developing into. We'll talk more about Intel and that 10% stake in just a moment. We'll speak to Angelo Zeno of CFRA, plus Danny Berger with your morning movers, and a move in sympathy with Home Depot from New York. You're watching Bloomberg TV. The opening about 2 hours away. Equity futures on the S&P 500 pulling back by just 0.1%. No drama so far this Tuesday morning. Down by 0.14 on the Nasdaq 100. With your morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John. The drama's even evaporated for Home Depot, which about an hour and a half ago reported earnings that were disappointing. Their comparable store sales for the second quarter up only 1%. The expectation was for 1.4. They talked about the fact that people weren't buying larger ticket items. Shares, though, have erased gains expectations are now up 0.2%. They did talk about a lot of purchases still for smaller DIY type things. So maybe that's helping keep things afloat. Just to flag, though, we're going to get Lowe's earnings tomorrow. Those shares are still down only slightly, 0.33% in reaction. We also had Medtronic earnings. This is the medical device maker. What a volatile session it has been for this company. First, the Journal, before the earnings, reported that Elliott had taken a stake in the company, was adding directors. Shares went up 10%. They reported earnings and shares fell. They're now down 3%. Despite some pretty solid earnings, they even upgraded their outlook, saying that the tariff hit would be less than expected, but maybe a buy the rumor, sell the news kind of thing happening here. Finally, Intel, those shares continue to rally this morning, up 5%, a big 12 hours for them, with the Trump administration reportedly mulling taking a 10% stake in SoftBank, investing $2 billion, buying that much of Intel shares. So again, those shares up 5% with the big bets from the government and SoftBank. John.
Danny, thank you. More from Danny in the next hour, plus more on that story in a few minutes' time. On our radar this morning, one of our top stories worldwide, President Donald Trump saying a meeting between Russian leader Vladimir Putin and the Ukrainian President Volodymyr Zelensky is in the works and could be followed by a trilateral meeting that would also include the President of the United States. Elsewhere, the outlook for U.S. credit remains stable. S&P Global affirming a AA+ rating, saying the revenue from President Trump's tariffs will help to balance the cuts made in the massive tax and spending bill.
Two things. Number one, exactly that is the reason why it is going to be so difficult for anyone to take these tariffs off. This is the reason why it's going to be politically incredibly difficult for whoever follows President Trump to reverse some of the tariffs, regardless of the legalities involved. That's number one. Number two, a kind of tension is emerging here. If you're counting on the revenues to really boost the deficit coffers of a government, that means that you expect to not necessarily bring that much production back to the United States. It is sort of a carrot and horse or stick or whatever the expression is. I never get the expressions right.
Anyway, live TV. Can we rewind? We can rewind. Start again. How about that? Your thoughts?
Well, there's this real question of, can you count on revenues for something that you hope to change on a structural basis? And that, I think, is what a lot of people are looking at.
Yeah, look, you totally nailed it. I'm going to stop laughing and you can too.
Thanks.
It's the ultimate contradiction of the policy. If you believe the tariffs will work, then you won't raise any revenue because the manufacturing will come home. And ultimately, if you're relying on the revenue, then you're also relying on the manufacturing not coming home. And
right.
That's the ultimate tension, I think, as this plays out.
Right now, it seems like a lot of companies are saying, look, it's better for us to keep importing goods from elsewhere, even by paying the tariffs, than to try to make it domestically. And I guess that some of the policy is counting on that continuing, with Scott Bessent coming out and talking about this with you, saying that all of the tariff revenues for 2025 could be well in excess of 1% of the United States' GDP.
So if you look at those numbers, he's looking for something north of $300 billion. CBO's telling you the recent bill that's passed will add $3.4 trillion over the next 10 years. You can see how these things stack up. Of course, none of this is going to be static, and it can all change over the next few years.
This is the reason why you haven't seen yields go even higher at the long end. And when you see some of the revenues coming in and some of the projections, you've actually seen long end treasury yields go down. So there clearly has been a pretty active type of discussion in markets about just how much the tariff revenue is offsetting some of what we're seeing with the expenditures.
And the carrots and horses and sticks and all of that. Like, I love that.
I don't know. It's like you put them together. What comes first, the horse or the carriage? The cart or the horse? Right. I hate
Is that
these
where we're
expressions.
going? We'll figure this out in a commercial break. I'm going to move on. I want to talk about Apple expanding new iPhone production in India. The tech giant wants to reduce its dependence on China for models being sent to the US and avoid new tariffs. All 4 iPhone 17 models will be made in India ahead of their debut next month. And this was the development that really irked this White House over the past few months, and I think put some daylight not only between the president and Apple, but also the president and India.
The fact that Apple is doubling down on this, though, highlights, A, how they cannot make policy according to what a tariff rate is threatened as at any given moment, and also highlights their determination to move away from China and depending entirely on production there. So to me, the fact that they're continuing with this, despite the fact that this raised ire with President Trump, shows the difficulty that a lot of companies are in trying to make long-term planning at a time of short-term policy shifts.
And stepping into the realm of speculation just a little bit,
Please.
If we were to speak to the trade strategist Tim Cook this morning and ask him, what does it tell you about what he thinks is going to happen with tariffs in India over the next 12 months?
Well, that's a great point, especially as they're being used as some sort of negotiating tool in the Russia-Ukraine talks. It seems like he's expecting those to come down in a material way.
That's the latest on Apple. Let's stick with tech and this story, a developing one. Shares of Intel whipsawing after sources here at Bloomberg reported the Trump administration is considering taking a 10% stake in the chip maker. Bloomberg's Tom McKenzie joins us now from London for more. Tom, that's about $10 billion. Where's the money coming from?
John, this is a conversion. The plan, at least according to our reporting, is you convert the subsidies under the CHIPS Act, of which Intel has received about $2.2 billion to date, but is in line to receive almost $11 billion. You convert that into equity. That gives you your approximate 10% stake in Intel. Again, according to our reporting. Is this a lifeline from the US government, or is it a vote of confidence in the CEO, Lip-Bu Tan, of course, whose fortunes have whipsawed under the pressure from President Trump? Came out of that meeting last week, and President Trump spoke highly of him and his background at a time, of course, when we have SoftBank and Masayoshi-son also putting in $2 billion into Intel. Of course, Masa has a relationship with Lip-Bu Tan. Lip-Bu Tan used to be on the board of SoftBank. What's clear from SoftBank's investment is they certainly see a vote of confidence in the Trump administration's policy, at least efforts to reshore some of that manufacturing to US shores. That came out. That was clear in that statement from Masayoshi-son. The key question around the government investment is, does this also apply to other tech companies within the US sphere? If you're Texas Instruments or Micron or Global Foundries, should you also be looking potentially at a US government stake in your business?
Tom, these are really thoughtful questions. I think something else that you've nailed, and I've listened to you, I've been hearing you talk about this over in Europe. The strategy of Intel was about to change. It felt like we were going into a world where you had to make a choice. You design or you build. And now the US government wants to build out domestic foundry capacity. I imagine they still want Intel to do both. Tom, do you see some tension there between what the strategy might have been and what it might be now?
To your point, John, look, this is a business that wants to be designing and competing with NVIDIA. It's not doing that yet. Its ambitions are to match NVIDIA in terms of nanometers, 1.8 by 26, towards the end of 26, I should say. And then there's the foundries business and that plan in Ohio for a super foundry. Those two aspects, design and build, not a conundrum, of course, that NVIDIA has to face up to with just the focus on design. The politics suggest that the Trump administration will want that build out of the foundry in Ohio, and the design is where the margins are. So that's a key question for investors, because another element that has not been put to play yet is an Intel that is better capitalized but still doesn't have customers for that mega foundry. If indeed what the Trump administration wants to see at the end of this is the build out of those facilities in Ohio.
Tom McKenzie with the latest. Tom, thank you, sir. I'm going to take that note and throw it over to Angelo Zeno of CFRA. He's got a hold rating of the stock, price target of 24. Angelo, I'm sure that you were following that conversation. That last point is a really important point. And I know you've explored it in your research because I've read it. Can you imagine a scenario where Intel builds out domestic foundry capacity and then the US government effectively puts pressure on fabless vendors to ultimately use it?
I mean, and John, I think that would kind of be almost the intent here for the U.S. government in many respects. I think if you kind of give Intel essentially a lifeline here in terms of funding, that really doesn't do anything if you think about it, right? I mean, it doesn't really solve the problem that Intel has here. And Intel really has two problems. One is the design aspect of things. It's having the right product out there to compete with the likes of an NVIDIA and an AMD, which they are, light years behind at this point, especially kind of in terms of having the right AI offerings on the data center server side. And then the other issue is clearly, as far as their foundry initiatives are concerned, ramping that up, finding external customers, to really take that capacity. And when you start thinking about that, really, I would think the whole objective here for the U.S. government is in many respects to try to strong arm their way into getting the likes of, an Apple or NVIDIA or Qualcomm or Broadcom, any of those names. Those were even names at one point considered to potentially acquire a name, Intel, right? So we'll kind of see how this all evolves. But I think ultimately, the U.S. government probably wants to push some sort of business to Intel in some way. I would say this, as far as the 232 semiconductor investigation goes as well, which we're still waiting on the details of that. The U.S. government, we've heard from Trump recently, is he's potentially looking to give an exemption here to potentially a company like Taiwan Semi, which would almost disincentivize companies from actually using Intel's local production. So it'll be interesting to kind of see how all these moving parts really work itself out.
SoftBank's buying, the United States government's buying. What would it take for Angelo Zeno to buy? For Angelo Zeno to actually see this is actually having a real upside ahead, with the prospect that at least more customers would be using their foundry?
Yeah, I think you definitely need a white knight in there, right? I mean, you need to get actual validation from a major external customer out there to actually give their stamp of approval to Intel and what they're doing. And I'm not necessarily talking about some token business that we've seen from the likes of a Microsoft or an Amazon. You need to have a company like an Apple and NVIDIA actually come out and give their full support to Intel. And again, this is something along the lines of potentially the U.S. administration going to NVIDIA and saying, hey, listen, help us out maybe in some respect and give Intel some business. And potentially maybe we'll say, maybe we won't charge you that 15%, from business going into China. So it'll be interesting. Again, it'll be interesting to how this stuff all plays out. But what we do want to see is something is in terms of a white knight in terms of that foundry business. And you also do want to see some success on the product side. But at this point in time, the product side just looks like it's just going to take a lot of work and a lot of time. But at this point in time, listen, I think this is a very hard buy if you're an investor. I think the opportunity cost is just way too high. There are just so many better opportunities within the semiconductor ecosystem rather than looking at Intel at this point in time.
Angelo, can you give us some color on what the barriers are that Intel has to cross in order to catch up to TSMC? What do they have to do? Is it on a talent side of things? Is it on an actual capacity side of things? Or is it in just a nuts and bolts hardware side?
I think, when you think about what we heard when Intel actually tried getting into the whole foundry space is that it was going to be a lot harder than Gelsinger at that point thought it was going to be. And a big reason for that is the servicing aspect of a foundry business is a lot more complicated than one thinks, right? So what they've actually been able to do over the last couple of years is to some extent try to, close the gap on the technology manufacturing side. And I think that's been a huge help. But, really they haven't executed and been able to really show external customers that they've been able to find success actually servicing and kind of meeting those, the potential obligations that these external customers have. And again, it's almost kind of an external customer out there really taking that leap of faith at this point in time more than anything else. In order for Intel to start finding some success. But if you actually go back just a month ago, I mean, Lip-Bu Tan actually was on an earnings call and said, no more blank checks, right? And you've now got the U.S. government in here almost kind of looking to accelerate some of these, initiatives and hopefully get Intel to get this all right.
Angelo, let's pretend that we're talking about China, and Intel's a Chinese company, and the Chinese government's about to do what the US government is thinking of doing. We wouldn't accept those chips. So let's talk about the Chinese business. How big is Intel's business in China? And what are the Chinese about to do if this carries through?
That is actually a great point, right? I mean, when you think about it, right? So about 30% of the revenue is from China at this point in time. And I think that to some extent, that's got to be at risk. I mean, there was an effort here, or there has been an effort by the Chinese government to de-emphasize a lot of, the US-based designers, but specifically when you look at Intel and even AMD CPU-oriented businesses into the PC market, there's a path here for the Chinese government to reduce their reliance on Intel and even AMD here over the next couple of years. So potentially you see that accelerate because maybe to your point, if you're the Chinese government, do you really want to be investing in Intel and leveraging Intel if it's somewhat owned by the U.S. government? So there is risk, at least for Intel's China business, I think, here over the next couple of years, if we see that U.S. government stake there.
Want to give you some credit, Angelo, not my point, your point. It was at the bottom of your note. Angelo Zeno. Angelo, thank you, sir. Appreciate it. Thank you very much. Angelo Zeno there of CFRA. The point on China is a really important one. Big slice of the revenue comes from that country. They're not going to like this development at all.
Yeah, the idea of state planning, how does that deal with the idea of national security elsewhere? And that's going to be a real issue, as China has already instructed some of its biggest tech players to avoid buying from the likes of NVIDIA and maybe Intel at a time where they can't really avoid that. And that's what we've seen in a number of different reports.
Intel so far this morning, just a little bit firmer. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Google is betting on nuclear power. The tech giant has struck a deal with the Tennessee Valley Authority and startup Kairos Power, the first binding agreement in the U.S. with a new kind of smaller, safer nuclear reactor. It will supply 50 megawatts to federal utility TVA, which powers Google's data hubs in the region. The project is expected to go live by 2030. Meanwhile, the amount of visitors to the U.S. arriving on student visas has plunged for its fourth consecutive month, with the biggest declines coming from Asia. U.S. universities have already warned that first-time foreign student enrollment on campuses are projected to fall by about 30% this fall, potentially costing the education sector $2.6 billion in tuition revenue. And Carlos Alcaraz won the Cincinnati Open final after Jannik Sinner pulled out due to illness in the first set. The match lasted just 22 minutes amid scorching heat and humidity. It was the fourth time this year the two superstars have met in a final. Alcaraz, who is ranked number 2, now holds a 9-5 advantage in his matchups with Sinner. Looking forward to the U.S. Open. That's your Bloomberg Brief, John.
Ditto, just not looking forward to trying to buy tickets because it's so bloody expensive every single year.
Qualifiers. That's where you get to see all the different players and you get to see a lot of things, and it's a lot cheaper. That's what my family's doing, but I'm at work.
Because it's nice over there,
yeah,
you know.
exactly.
It's a nice experience.
Out. You know, some people are friends with the ball boys, etc.
We'll have a rant on New York sports another day. It's just expensive. Up next, waiting for a response from the Fed.
The Fed needs to respond to what's actually happening in the real economy. Demand is the principal reason why labor market conditions have slowed, and that's something the Fed ultimately will need to respond to.
Just this massive concentration of wealth in one city. They all like the same sports, and anyway, I couldn't hold it in.
Access, yeah.
Couldn't hold it in.
Everyone was waiting for it, so.
Premier Minister of JP Morgan joins us next on the bond market. Live from New York City, welcome to the program. Under surveillance this morning, global bond yields ticking higher ahead of comments from Fed Chair Jay Powell due Friday. Premier Minister of JP Morgan writing, the dual mandate is in tension, but we think a September 25 basis point rate cut is likely and a signal for more cuts to come as the Fed removes the level of restriction in monetary policy. For more, Priya joins us around a table. Priya, good morning.
Morning.
It's good to see you. RBC has talked about this. A lot of people are focused on it. Is the long end becoming unanchored from the front end? Not just domestically, but worldwide when you look at the bond market at the moment?
So I'm glad you bring up the global side because I think that's absolutely important. Global term premiums are correlated. The fact that we have fiscal expansion globally, the fact that there isn't that much demand for long duration is the reason why UK, German, Japanese long end yields are rising, and that's raising US rates as well. But I mean, talking about the long end getting unanchored, sell America or the deficit, that's like very April. I mean, I know it was only a few months ago, but you look at the tariff revenues, they're coming in, they're actually offsetting the OBBB, the one big beautiful bill. I think it's going to largely offset it. You look at the sell America trade, we're not seeing evidence that foreign investors have stayed away. Now, there is a longer term question. How much should Treasury, and I love your question to Secretary Bessent, how much should you issue in the long end? I think all Treasury departments have to think about that and maybe not issue as much in the long end. And that might be happening. Issue where the demand is. The demand, and you see it in the credit market, the mortgage market, the Treasury market, demand's in the belly of the curve, 5 to 10 year. That's where they can issue. So yes, it's a little unanchored. You can trade the curve on that front. But I don't think we're looking at a scenario that bears steepener, which is the nightmare scenario for risk assets as well, is when all rates rise led by the long end. We're not seeing that. I think the curve is steepening for different reasons now.
Are we going to see the opposite? You said that sell America is so April. Okay. Are we actually outright into buy America again as we see the dollar firm up in a couple of different pockets? And the long end, yes, yields have been rising, but not necessarily unmoored in the way a lot of people were worried about.
Exactly. So I do think that U.S. exceptionalism, remember we talked about it just a few months ago, is that over? Look at the economic data. We're pricing it. Look at financial markets. I know the financial markets is not the economy, but it is pricing in. I think markets across the board are pricing in a soft landing and what Governor Waller called good news rate cuts, that maybe the Fed can reduce accommodation. Those rates can fall a little bit, allowing the broadening out of the recovery. I mean, we have the structural AI tech capex in there, but maybe this can broaden out. That's what the market's pricing in. So to your question, is the rest of the world buying U.S. assets? They are. They're buying credit, they're buying equities, they're buying treasuries, fixed income, because they're seeing that the U.S. is still growing the best.
Are you going long duration? Is this a time to buy, even at a time where potentially there is inflationary pressure coming down the pike?
So we are long duration. We've looked for any opportunity. We've been in this 375, 4.5 fair value in our mind. That's the soft landing fair value. There's an asymmetry though. If things slow down, we have a lot of policy shocks that have hit the economy. If things slow down, we can absolutely rally more. But if we stay in the soft landing, by rally more I mean lower rates, but if we stay in the soft landing, 430 on 10s is cheap. You're near the upper end of the range, so absolutely, we've been buying some duration. Are we max long? No. There's, to your point, the Treasury interest rates are driven by this fear of inflation, fear of growth. There are shades of stagflation in the data right now. I don't think Chair Powell is going to commit to a rate cut. I think he's going to just signal the easing bias. So we might hang around here. But what happens if I think the labor market's on edge. And if things actually slow down, as companies say, we can't absorb all of this in margins, we're going to have to cut costs. That's a fear. That's what keeps me up at night. And at that point, duration's the only friend.
Do you think there's scope for disappointment on Friday?
I think we get a lot on Friday. So I always think of the economic outlook and the reaction function. If you're looking for Chair Powell to signal imminent rate cuts or a dovish reaction function, I don't think we're going to get that. I think it's going to depend on, so where the disappointment might come in is, well, he didn't commit to September. He still left the door open because we have another payroll report, revisions. Now, I think the market might pay more attention to revisions along with that number, something that frustrated me for years, that you get both sets of data and the market always looks at the headline. Maybe we'll look at both. You have another CPI report. So I think where the disappointment will come in is no commitment. But I'm going to be watching that framework review. That's going to sound maybe a little bit hawkish. They're going to talk about symmetry to the unemployment rate, symmetry to inflation.
Yeah.
That might sound a little hawkish, but I'm watching the economic outlook. How nervous is he that consumer spending has slowed, that PDFP, the private domestic final sales, that number is slowing without that much rise in inflation. So why is the consumer pulling back if companies are not passing on costs? Means there's maybe some underlying slowing here.
Priya Misra of JP Morgan. Based on what you've said, I imagine that speech is going to be a lot longer than 8 minutes. Just based on those comments. From New York City this morning, good morning. The third hour of Bloomberg Surveillance up next.
It's been messy for the cyclical side of the market.
You don't want to have a scenario where tech and tech capex slows down.
The market's back where it was, or heading at least in the direction of where it was last year.
You can take a look at where risk is priced right now, and I think reasonably conclude it's relatively rich.
The market figured out and kind of agreed with me that the economy was resilient and we're not going to have a recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is a no-drama Tuesday so far, at least. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now with equities just off all-time highs, pulling back by not even 0.1% on the S&P. Similar move on the Nasdaq. Had Home Depot report earnings a little bit earlier this morning. I'll use that phrase again. No drama from them. Then on to tomorrow, we're going to hear from Target. The day after, we'll hear from Walmart, and then the man himself on Friday, Chairman Powell just a few days away.
It sets up the preamble perfectly to understand the dual mandate of both employment, the idea of how much the labor market continues to be firm versus inflation. And the retail earnings are going to be really key with that. Home Depot coming out and saying that they didn't have to pass along the prices quite that much over the past couple of months, partly because 50% of their items are sourced from the United States, but also they imported a lot of goods ahead of the tariffs getting implemented. Going forward, not so simple. And to me, that is one of the key questions. How much is this delayed, the inflationary impact of some of these levies?
The most important thing I think we're going to have discussed in the next 60 minutes or so with Jim Karen of Morgan Stanley is about what happens in the next few months, and not just obsessing over downside risk, but considering the prospect of upside risk, the potential for a re-acceleration in the US economy. I think that's really, really important, because what you just heard from Home Depot was important. What they said to you was that you could see activity delayed and not derailed, which also means in the next few months you could see things pick up once again.
If you get certainty of tariffs, if you get certainty of policy, and this is ultimately the key question, are we discounting some of the weakness without considering what will happen down the pike? The idea of people putting off big ticket items doesn't mean that they're never going to do them. It means that they are waiting for more certainty. One rate cut could actually ignite that. The idea that they're going to pass along price increases down the line also highlights the idea that they think that investors are going to be able to accept them. This from Goldman Sachs. I thought this was fascinating, an analysis that came out. They estimate that companies are paying 64% of the tariffs currently, but that ratio will drop to 8% by October. Consumers currently paying about 22%. They expect that to go up to 67% of the tariff costs coming by October. It just shows this is coming down the pike. The question is, will consumers be strong enough to absorb that? And then how much does that shift market expectations?
Equities this morning negative by not even 0.1% on the S&P. Coming up this hour, Jim Karen of Morgan Stanley as markets eye Fed Chair Jay Powell in Jackson Hole, Chuck Grommer, Gordon Haskett in a busy week of retail earnings, and Gene Soroka of the Port of Los Angeles as they brace for the impact of new tariffs. We begin this hour with stock steady as investors await a sign on rate cuts. Jim Karen of Morgan Stanley saying the following: I expect Powell to acknowledge downside risks in the economy, but not signal a rate cut is 100%. Jim joins us now for more. Jim, welcome to the program, sir. It's a lesson you taught me a long, long time ago, to consider that risk cuts both ways. Can we talk about upside risk? What is the potential for that upside risk materializing in the months to come?
Thank you, John, and thanks for having me on the show. Look, I think there's a lot going on here, and what we have to recognize is that a lot of things are in flux at this moment. So we're transitioning our economy from a dependence on the government sector in terms of job creation to now shifting towards the private sector. We're in that very uncomfortable in-between period where you're going to see weakness in the labor report. These are the numbers that are likely to come up. I think it's early September 9th. We have another quarterly census of employment and wages, which is the downward revisions that we're expected to get in previous month payrolls. All of this is in front of the next Fed meeting, which I do think that the Fed is going to cut 25 basis points. But when we look forward, when we look into the future, what that means is that the labor supply had been taken up by the public sector, meaning by the government sector. The majority of job growth that we've seen over the past few years has come from the government sector. Now that's going to shift over to the private sector as we go into late this year, 2026. Now, what the demand is going to be, I think, likely is going to come from the tax and budget program that was passed by the Trump administration. A lot of the CapEx investment that we're seeing, a lot of the FDI that's coming in from foreign countries, is going to be a large surge of that investment coming into the U.S., which means that private sector jobs are actually going to start to lead the growth. Private sector jobs over the past few years have been relatively flat to going down. Public sector jobs, government sector jobs have been actually going up, and that's what's been keeping things buoyant. Now we're going to see a shift in this mix. And I think that is going to be the leading indicator for there to be a broadening out of markets, and that could be a positive element going forward.
Jim, just build on that. How do you want to position for that transition in the U.S. economy?
So really, it's in terms of positioning in portfolios, it's really a broadening of the equity markets. So what we've seen right now are the CapEx leaders. These are the Mag 7. These are the big tech companies that we all know. They have all the money, so they can do the early investment, and that's what's really been propping up and boosting up the economy and a lot of the data. What we think can happen going forward with the tax plan and all the CapEx and all the investment that's coming through, that the labor supply that's going to be available to the mid-cap sectors and to the broader, say, the other 493 across the S&P 500 is going to be labor at a reasonable price. I like that phrase, labor at a reasonable price, which means that wage inflation doesn't necessarily have to pick up, which is good news for the Fed because they don't have to worry about extended inflation, but you can still have a growing economy. So I think the broader, more cyclical sectors, manufacturing, industrials, all of those sectors can actually stand to gain going forward, and that, tech leadership will still be there, but I think that leadership mantle is going to be shared amongst a broader cohort.
How much is that sort of broadening out predicated on the idea of an ongoing slew of rate cuts that start as soon as next month?
I'd say that rate cuts are helpful. I don't know that it's overly predicated on it. Rate cuts help valuations for sure. I mean, it's certainly not a headwind, but I think it's mostly predicated on the accelerated depreciation, the CapEx plans that have yet to be started. Right. Remember, this bill was passed in early third quarter. The tax bill was passed in early third quarter. Businesses are yet to actually really start to, in the broad sense, in the more broader sense of the market, are really yet to actually start to make this investment and actually start their growth plans, because now they know what the tax plan is. There's a lot of pent up demand that's likely to come through, and that's going to help GDP. That's going to be for the broader parts of the market to actually generate some of that growth. Look, this is a risk to the upside, and John knows I like to say this, that the risk to the upside is still a risk and it needs to be hedged. That's my tagline, right? We have to look at risks as symmetrical. There's both upside and downside. So when we look at asset prices today, I don't think the market's necessarily overvalued in an equity sense. I just think the market is taking into account that there is potential for there to be upside, and it's balancing itself right around here. And there is downside risk too.
Well, okay, so a lot of people have pointed to a lot of the aspects that you just talked about and say a lot has been priced in. You look at the 493 at something like 22 times earnings, just in terms of valuation. Even when you strip out the Magnificent Seven and you wonder, okay, is that still not accounting for some of the efficiencies that you're talking about, whether it's AI, whether it's just the idea of the investment that's coming from the tax bill that was passed? How do you decide what's already been priced in and what potentially has yet to be factored?
Lisa, that's a fantastic question. All right, so let me break it down. If we go back to January 1st, 2025, start of this year, the 12-month forward earnings for the U.S. were somewhere between $300 EPS, $300 to $310, somewhere in that neighborhood. Now, what happened is we had tariffs. There was a lot of turmoil in the economy. Analysts took those numbers down to 265, 280, 285, which is where they stand right now. What if we get back to EPS expectations back to where we were at the start of this year, around $300, $310, and you brought up the 22 PE multiple. Let's say that multiple stays exactly where it is. So now you've got 22 times $310. You're looking at an S&P that could get to 7,000. I'm not making that forecast. All I'm saying is that when you draw the distribution of probabilities, that's in there within a first standard deviation move. So it's possible that you can get there. And that's the upside potential in terms of valuing the markets.
Jim, just before you go, I just want to wrap it up. Sort of get 35,000 feet and think about where we are at the moment and where we have been over the last decade plus. Bull markets in this country for a long, long time post-GFC have been absolutely despised. They've been hated. And it feels like to some extent this is no different. I hear a lot of people pouring freezing cold water on this market, whether it's narrow breadth, concentration. There's always a reason to hate this stock market rally. Jim, when you speak to clients at the moment, do you hear any exuberance whatsoever? When you hear things like bubbles, are you seeing any of that in your career? Lean on some of your experience. Any signs of that at all?
I'm not seeing that. I'm seeing a lot of skepticism to the upside. And, as I also like to say, the markets keep disappointing to the upside, right? Because it means that people aren't fully positioned to where they want to be. The downside risks are very clear and they're very evident. We know what can happen. We can have a sharp decline in the jobs market, tariff pressures could start to bite, margins start to compress, and you could have a significant slowdown. We know those risks exist. And I acknowledge those risks as well. And I think most people fixate on that primarily because it's tariff driven. But what people aren't seeing is the benefits, the cost reducers. Tariffs increase costs. The cost reducers are the deregulation and also the reduction in tax costs. When you net those two things together, there could be a positive outcome, but it's hard to solve for and it's not readily apparent. So that's why I don't think you see a lot of that exuberance to the upside at the moment.
Jim, appreciate it. Thank you, sir. Jim Cameron there of Morgan Stanley. Disappointment to the upside. It's what it's felt like for a long, long time for a lot of people not riding this rally.
When you look at the 13F filings, you see that hedge funds and other institutions have been chronically underweight NVIDIA as they look to other places to outperform. And you can just imagine that that has been a chronic disappointment as well.
Stocks very close to all-time highs on the S&P 500. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. We start with our top story. President Trump is pushing for a one-on-one summit between Ukraine's President Zelensky and Russia's President Vladimir Putin to discuss terms that could bring an end to the war. Trump urged Putin to consider the plans after European leaders joined Zelensky at the White House yesterday. The summit would be followed by a trilateral gathering involving President Trump. Meanwhile, NVIDIA shares are edging higher by 0.2% as the company is reportedly developing a new AI chip being called the B30A. According to Reuters, the chip would specifically be for China and would be more powerful than the H20 model. The B30A is likely to deliver half the raw computing power of NVIDIA's flagship B300 AI chip, which is part of its Blackwell architecture. And Starbucks will give 2% raises to corporate employees this year, moving away from merit-based increases as the coffee giant looks to rein in costs. The pay bump will go to North American corporate staff, retail managers, and U.S. manufacturing workers later this year. Starbucks is in the middle of a major turnaround after 6 straight quarters of falling sales. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next, the Morning Calls Plus. Chuck Grom of Gordon Haskett with a busy slate of retail earnings well underway. That conversation up next. Live from New York City this morning. Good morning.
There's two sort of distinct markets out there today, right? There's the new construction market where the home builders have the ability to buy the rates down, and they've done that very successfully. 90% of sales historically have been on the existing home side where we do need rates to come down. And that sort of turnover in the existing home market is critical to the long-term success of the market.
That was John Lovello of UBS on a housing market in the United States, a housing market that he's still pretty constructive on. If you're just joining us, welcome to the program. Equities at the moment on the S&P, lighter, softer, negative, down by not even 0.1% on the S&P 500. It's been a quiet few days so far this trading week. That's the price action. Let's get you some morning calls. First up, Citi raising its price target on 5 Below to 143, expecting comparable sales to drive a second quarter earnings beat. Your second call from Bank of America cutting its price target on Gap to 21, saying tariff pressures will weigh on margins. And finally, Piper Sandler raising its price target on Dollar Tree to 112, citing improved fundamentals and trade down benefits. Let's stick with retail. Investors looking for signs of inflation in big box earnings ahead of comments from Fed Chair Jay Powell in Jackson Hole. Mike McKee is in Jackson Hole and he joins us now for more. Good morning, Michael. Let's just talk about what we've learned so far, what you see in the data and what you're hearing from corporate America.
Well, I think the important thing today, of course, John, is housing starts, which have not been good because builders have been holding back to wait and see what happens with interest rates, as we just heard. And the question is Jay Powell going to give us any kind of indication about when interest rates might come down? The betting is among analysts that he won't, that he'll keep his options open because there is more data to come. Now, the interesting thing about all of this is, of course, that if the Fed were to lower rates, but the markets were to think that perhaps the fiscal policies we have now were going to cause inflation, it wouldn't bring mortgage rates down. It would probably raise the long end, and mortgage rates would stay where they are or go up.
Mike, this is an important point. Just how much pent-up activity is there in this economy waiting for lower interest rates, whether it's the front end or the long end?
Well, there's a lot of pent-up, it's not just demand, it's a desire to sell as well. A lot of baby boomers, the kids are gone, the house is too big, they want to sell, but they don't want to get out of their mortgage. So there's a feeling that if mortgage rates come down maybe into the 5s, you'll start to see some action out there. But that's going to take a while. So it isn't going to be housing that's going to drive things soon. And you saw today with Home Depot earnings that it's affecting the broader economy because people aren't buying the things that go into houses as well.
Mike McKee, some data dropping in about 12 minutes' time. We'll cross over to you in just a moment. Stay close. Mike mentioned Home Depot. Let's stick with the consumer and Home Depot. Given a warning as consumers pull back from big-ticket items. Chuck Graham covers Home Depot for Gordon Haskett, has a hold rating at 380 price target. Chuck joins us now for more. Chuck, just first of all, what's the big takeaway so far this morning for you and the team?
To be honest with you, it's kind of a non-event. 1% comp, pretty much in line with expectations. EPS was in line, backing guidance, and it's really more of the same out of these home improvement retailers. Really just continue to bounce along the bottom. As some of your prior guests have said, we really need housing turnover to really trigger demand, and right now we're not seeing that. So business is okay, and right now we're waiting for that inflection, and we're just not seeing it yet.
Chuck, do a couple of rate cuts get it done, or do we need to see more than just that?
The survey work that we do shows that if you get mortgage rates below 6%, you start to see an improvement in demand. You really kind of need into that mid 5% level, given where rates are and where people are sitting on their current mortgage rates. So probably need more than just a couple.
How much does Home Depot stand in a better position than the others, just simply because so much of their inventory comes from the United States?
Yeah, that's a great point. And with prices moving higher over the next couple of quarters, I mean, Home Depot, Lowe's, the two big box guys are in great shape relative to some of their peers. But like I said earlier, we really need to see rates move lower. That's the big thing. Big ticket just continues to be weak. We think on their call at 9 o'clock, we hear about certain seasonal categories doing a little bit better as we progress throughout the quarter. We think the exit rate in July was probably better than the entry rate in May. That'll give people some hope as we move into the back half. But their guide, in our view, still looks a little bit of aggressive. If you look at the 2-year stacks, what they need to do to hit that 1%, they really need a big improvement. We're talking like 300-400 basis points of a comp improvement for them to hit that guide. And right now that looks a little bit aggressive.
Chuck, we were just talking to Jim Caron about the potential to the upside, the risk to the upside of potential reacceleration. And one thing that you keep saying is we need rates to go lower to restart some of that demand. What we heard from Home Depot was a lot of people putting on hold some of these plans. If the Fed does cut rates substantially, just how much could that reaccelerate the business and give them the ability to raise prices as they plan to do with the marginal increase in tariffs?
Yeah, I mean, it could be a multi-year tailwind. And if you look at the valuation of Home Depot in particular, trading at roughly 25, 26 times forward earnings, which is roughly a 3 or 4 turn premium to historical levels, the market's kind of anticipating that. I mean, these stocks are flat on the year, and their comps have really gone nowhere for several quarters in a row. So the market's certainly anticipating that. And if you look at home improvement spend as a percentage of total PCE, it's gotten back to sort of 2019 levels. So there's no doubt about it. The home improvement vertical is probably the best that I cover. And when I think over the next 10 years, there could be a tremendous amount of demand that gets unlocked.
That's one segment of the companies that you do cover, Chuck. When you look across all the companies you cover at the moment, are there any potential landmines? I often ask you this question that some of these companies might have stepped on, given the amount of policy change we've seen in the past few months and anticipation of that policy change as well.
Yeah, I think the one, it's a good question. If you look at the big, beautiful bill and some of the pending changes to tax rates and where things are going to fall out early next year, there's a little bit of concern at the low end when we start to see Medicaid cuts and SNAP reductions. So that's, I don't know if it's a landmine today. I do think you are seeing some trade down effect or trade in. But I do think the low end is something low end income. We're going to need to see, keep an eye on that as we move into the beginning of next year.
Chuck, we've heard from a lot of companies that they're absorbing the tariffs, that they're cutting some of the margins in order to remain competitive, especially for that low end consumer. At what point have you started hearing, or have you already started hearing about layoffs or trimming employees on the margins to compensate for that? We were just talking about Starbucks and the fact that they're only increasing wages by 2%. I mean, that's below inflation in order to restrain costs. How much does that sort of start to bleed over into the labor picture?
That's a good question. I mean, right now, I mean, the price checks that we've done would tell you that we haven't really seen a big increase in pricing. We're talking like up like 2.5%, 3.5% relative to in early April when we started to do these checks and when tariff increases started to come into effect. I think if you were to sort of guess the over under and what people thought you'd see by August, people would have taken the over relative to that. So it doesn't really seem like we've seen those price increases yet. Now, every company we talk to is telling us mid-August into September, into October is when we're going to start to see that. The second derivative of that, could we start to see job cuts and layoffs? Certainly. I think wage rates in general have been relatively benign over the past couple of years. Remember what we saw in the early part of this decade, big changes to labor rates. It looks like that's starting to level out right now.
What are you looking for on Thursday when we get Walmart results? That's going to be kind of a linchpin moment, considering that they're the biggest private employer, but they also are really head-to-head when it comes to Amazon and when it comes to shipping, when it comes to technology, when it comes to warehouses. Yeah. What are you looking for?
I think Walmart is in a market share gaining mode right now. I think that's the approach they need to take. It's really the Costco approach. I think they're going to stay aggressive on keeping prices low. I think they want to gain customers, and if that comes at the expense of margins in the near term, they're willing to make that sacrifice. And I think right now that's what we're going to be focused on. I also think they had a really good second quarter. I think they are gaining market share. Our checks would say that early part to back to school, back to college has been really good. The U.S. consumer is healthy, very healthy. And I think the outlook is what I think where Walmart probably poses a little bit of prudence, just given where prices are going and the uncertainty that's still out there.
Hey, Chuck. Good to hear from you. Chuck Grom there of Gordon Haskett. Very, very different conversation with Chuck there, who covers these retailers compared to, say, an economist following payrolls a few Fridays back.
If there is this incredible weakness, where is it if you look at the retailers that are coming out showing how, they're choosing not to pass along the price increases in order to gain market share, not necessarily because their sales are going to fall off a cliff. Again, this points to the strength that's on the other side, the upside risk that Jim Caron was talking about.
Great conversation to kick off retail earnings. More retail earnings come tomorrow, Target, and then on to Walmart. The big focus for Lisa and for all of us here at Bloomberg Surveillance. Up next on the programme, we'll get some breaking economic data on housing. Plus, Rob Stocken of Citi expecting payback for goods front-loaded ahead of tariffs. That conversation just around the corner with equities close to all-time highs. Futures negative by not even 0.1%. Bond yields lower by a single basis point across the board. 2s at 375, 10s at 432. From New York, you're watching Bloomberg TV. Equities on the S&P 500 totally unchanged. Likewise on the Nasdaq, we're down by close to 0.1% here, just a little bit softer. Going into some economic data just moments away and an opening bell about 60 minutes away. In the bond market, 2-year, 10-year, 30-year bond yields shaping up as follows. We're down about a single basis point across the curve. On a 2-year, down to 375. On 10s at 432. 30s yesterday creeping closer and closer to 5% this morning. 491.93 and down a single basis point. With some economic data, housing starts, building permits, housing starts, just crossing the Bloomberg terminal. Let's get to that data right now with Mike McKee. Good morning, Mike.
Good morning, John. An upside surprise for housing. Builders started new homes at a 5.2% annual rate increase, which is much more than the negative 1.8% that was forecast. It puts us at a 1,428,000 annual rate. That's up from 1,321,000. So builders perhaps getting a little more confident in the idea that the Fed might cut rates and people might come back out again to buy houses. Building permits were down, though, 2.8%. So it's a kind of a mixed picture. They had some confidence in July, but what's it going to be like as we go into the fall?
Mike McKee, I just wonder how sensitive the Federal Reserve is to this one data point, not housing starts or building permits, but the housing sector, this industry. Mike, we've been having this conversation repeatedly on this program recently about what the Federal Reserve would do if they started cutting, but interest rates started to go higher at the long end of the curve. Mark Summerlin, a man who you know, of course, a Fed chair candidate, came on the program in the last week or so and suggested that if he saw that, they should stop cutting. Stop almost immediately, Mike. How sensitive are they to a repeat of what we saw last year in Q4?
Oh, they're very sensitive to that. They're going to be keeping a very close eye on it because, remember, they think that it's a very close call as to whether you should even cut rates at this point because of the possibility of inflation. So they're going to be watching what the market reaction is because whatever the Fed does won't get into the markets, won't get into the financial system for 6 months to a year, whereas the market reaction, especially at the long run, will be immediate. So they're going to be watching that very closely.
Mike McKee with the latest. Mike, looking forward to your conversation later on this morning. Mickey Bowman, Mike McKee, sitting down together 10 a.m. Eastern Time from Jackson Hole, Wyoming. One of the key dissents in the last month or so on the FOMC. Looking forward to see what Governor Bowman's got to say about some of these issues.
Yeah, and how it's going to be messaged in Jackson Hole, given that they're doing the framework review, whether it's relevant, given the fact that Jay Powell might not be the chair come next year. He will not be the chair next year. I do wonder about the housing market and how much that is an indication of weakness, given that it's been completely divorced from the economic cycle for a number of years now. And we see that again today. What can we infer from this? Not a whole lot. People are trying to navigate this around the edges, but ultimately it counts on whether rates go down and how much that can ignite some of the demand.
Yeah, which rates go down.
Exactly.
And that's the important piece of it. We've both been talking about it and you've been on top of it too. This has become a really, really key political issue in this country. First and foremost in this city, in New York, and will be in months to come. And there seems to be some confusion between the relationship at the front end of the curve and the long end of the curve. The pressure that you're seeing on the Federal Reserve to cut interest rates is for a whole bunch of reasons. But one of them, there is a belief from politicians at least that can help unlock some activity in the housing market and maybe make housing more affordable if you believe that housing should be more affordable based on a monthly payment and not on the price of the house. More on that later. Anyway, that's the issue this Federal Reserve has now got. They could cut rates and mortgage rates could go up. We saw that last year. Could it happen again?
Right. We saw 100 basis points of rate cuts in the front end. We saw 100 basis points of an increase, essentially, on the 10-year yield. So in the opposite direction. A real concern here about whether there is inflationary pressure. And if there is, if they cut rates too quickly, that could unleash steepening, not necessarily the flattening or just some sort of all-around curve coming down, as many people would like to see.
The pandemic screwed up this housing market in this country. This housing market reset to interest rates at Fed funds of 0, a mortgage rate of 3, and here we are now, and it just doesn't sync up. Something's got to give. Something's got to give. I don't know what, but something's got to give.
I apologize in advance. I'm pulling out my little soapbox and I'm getting on it.
Sure.
So many people come on and they say, when I was a kid, I could go out and buy a house and it wasn't that big of a deal. I remember when it was $300,000 and, guess what? Mortgage rates were at 10%. Well, yeah, they could still buy a house with mortgage rates at 10% because they cost so much less than what they do now. So it's been years and years and years in the making of inflated pricing. And now all of a sudden you've got a generation that can't get in. And a real question, how do you deal with it? Sure, housing supply is going up marginally, but is it in the right areas? Is it the right type of homes? If we hear about Toll Brothers being, going ahead with these monstrous houses for wealthy individuals, it doesn't really work for the entry level. I'm coming off my soapbox.
No, I'm right there with you on top of the soapbox doing the same thing, so don't worry about it. I've heard those guests talk about those things. I know it drives me insane.
Yeah, it's like it's been a very different landscape.
Different generation.
Yes, exactly.
Certainly nothing easy about the 70s into the 80s. Not playing that down if any boomers are watching. I'm sure you are. I understand that. But it's a very different situation, which is why you see these younger cohorts voting the way they are. I don't know if it's the right way to be voting. I think you know what my view is on that personally. It's another conversation for another day. But ultimately, that's the way they're looking to vote. They're going further to the left.
Yeah, because ultimately, if they don't have access to home ownership, then they start to getting concerned about the cost of rent, which is also going up. And it's the reason why a lot of cities are really grappling with this.
Rob Sockin's got lots to say about this. Don't worry, Rob. I'm not coming to you on that. He joins us from Citi. He's got this to say. Recent labour market data increased the scope for a Fed cut as soon as September. We expect that the Fed will look through elevated inflation in the coming months and favour the growth side of its mandate. Rob joins us now for more. Rob, good morning. Good to see you. Less on housing and less on the politics at the moment, much more on this Federal Reserve going into September. What do you expect to hear this coming Friday?
I think Chair Powell's in a tough spot going into Friday because we've got a long way to go until we have that September meeting you referenced, and a lot of data in between now and then. On top of that, he has the political pressure on the back of his neck he's been dealing with some time. So he can't lean one way or another, in my view, in this speech. So it's going to be a lot of here's what's happening with the labor side of things. There are a lot of factors going on. Here's what's happening with the inflation side of things. Fairly muted so far, but we expect more to come. We have to wait and see. And so he's not going to lean too strongly one way or another. Ultimately, I do think that we're going to see more softness in the second half on activity, a bit more inflationary pressure, and that's going to lead to those cuts that I was referencing. But I think it's too soon for him to lean too strongly into that.
So you think it's going to be a snoozer? Is that what you're saying?
I think a bit of it. I mean, I think there's going to be interesting issues in the speech. As I said, there are a lot of interesting things going on in this economy. Labor market's a good example. We've had a lot weaker labor reports recently, but we're also getting a contraction in labor supply. At the same time, we're getting a slowdown in labor demand. Where the break-even rate is for the labor market and what holds the unemployment rate constant, not clear at this moment. So I think those issues will be outlined.
If the focus is on growth, which has been the focus for the Fed, the feeling that if there is a recession, the negative effects longer term of a loss of employment is so pernicious that you want to avoid that at all costs, even if it comes with higher inflation. Does that mean that they are biased to allow inflation to be perpetually above 2%? And I say perpetually, but at least over the next few years. Is that essentially a Fed that is willing to accept 2 to 3% inflation, not just 2% inflation?
Yeah, and I think this is the challenge with targeting 2% inflation is I think in this environment or in any environment, I think they wouldn't explicitly say it this way, but if inflation goes down to, let's say, something like 2.25%, I think they'd be just fine with that. I think once you're getting to numbers that are closer to the high 2s into the 3s and even higher than that, that's where the discomfort starts. So it's really a soft target around those numbers. And in our own forecast, core inflation rises to about 3%, maybe even a little above by the end of the year. I think those numbers are too high, but they still favor the growth side of the mandate. And if they think that the inflation will subside over a few quarter period, they're willing to put a few rate cuts through. So it's a balancing act. If inflation goes much higher than we're forecasting, which I don't expect, then I think rate cuts are less likely. So it's really about where is inflation heading and how willing are they to look through that to support the growth side.
They've been looking through it now for years. They've missed their target for 4 years.
Yep.
Inflation is close to 3%. It is in the high 2s. I don't sense any discomfort whatsoever. Do you?
Yeah, it's a great point. I think they're, they...
Well, I hate to be snarky about it, forgive me, but seriously, the chairman doesn't come out and sound uncomfortable with where inflation is at all.
Well, they started some rate cuts last year, and I think they paused it because they felt that there were risks to inflation, and inflation was grinding down slowly. But I do agree with the progress they've been seeing. They don't sound particularly worked up about it. And without the tariffs and those effects, if inflation were to continue to moderate in the way it was, I think we would still be getting gradual rate cuts. But it's this potential tariff effect which could lead to a reacceleration. That's what has them, I think, worried in the back of their mind.
Do you think rightly worried?
I think, again, so far the tariffs have been less disruptive than we would have thought. Companies seem to be absorbing these tariffs to a higher degree than we would have expected. But I think that argument has its limits. I think companies are running through inventory that they built up, trying to avoid putting through those tariff increases. And I think when we speak with a lot of companies, they've been waiting to see where the tariff rates are going to land. I think with where they seem to be landing now, which is an effective tariff rate on U.S. imports somewhere close to 20%. I think that's too much for them to absorb in their margins, and you're going to see more price increases for the consumer as we head into the fall. So I do think there is cause for concern, even though we haven't seen those real inflationary effects to the same degree that the Fed and many of us have been expecting.
So there's the inflation side and there's the labor market side of things. And people are wondering just how much weakness was implied by some of the non-farm payrolls reports that we've gotten in the revisions that really point to a much greater degree of weakness. Other people saying this is just the natural rate of things, given the supply side of things, the fact that immigrants aren't coming to the United States as much as they were in the past. How much do you expect to hear some insight there? Why they see this market as in transformation and sort of difficult to interpret?
Yeah, absolutely. This is the exact issue we were talking about earlier, where you're getting the slowdown in labor supply and demand. So where those meet, you should naturally expect payrolls growth to be lower than we've seen for the last few years. I do think that the size of the revisions that we saw and the pace we've seen over the last few months is below most estimates of that. Now, the labor market data are noisy, as we've seen, as the administration has also highlighted. And we saw some of this last year where things were slowing down and then the labor market picked back up. So I think they're going to highlight that there are risks there, that the revisions and the extended payrolls is worrying. But it's a complex picture and they're waiting to see how things evolve. I mean, there are other labor market data that are much less concerning than that. If you look at the weekly layoff data that we get, still really no signs of a sharp slowdown in those figures.
Rob Sockin, good to see you, sir. As always, appreciate it. Robert Sockin there of Citi. This from Steve Cheverone of Federated. He writes in and says, add me to the soapbox too. It's very generational, this stuff, isn't it?
Well, we're so sick of hearing people come out and say, you haven't seen anything. I remember when rates were this level and it was just fine and I still bought a house. And you think,
for a bag of peanuts.
Exactly, for $10,000, in some prime location. I will just add to the soapbox this aspect.
Please do.
You start talking about the labor market and how maybe it's better than expected. Kevin Gordon puts this out on X, and I think it's a really compelling one. The unemployment rate for 16 to 24-year-olds is up to 10%. Yeah. That is the highest it has ever been outside of a recession, and speaks to the sort of generational divide and a question of where the opportunities really lie. At the same time, that housing market costs very much are front and center.
It's a fantastic point. Get rolled up in this hour, don't we?
I think so. I mean, if there's nothing else going on, then we pull out our soapboxes, we get on them, and exactly. Pitchforks.
The 1980s. Let me get you an update on stories elsewhere. With your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. President Trump widened steel and aluminum tariffs to include more than 400 consumer items. U.S. importers were given little notice ahead of the change, which went into effect Monday and included items in transit. The levies will apply to a wide range of items, including auto parts, plastics, baby booster seats, and furniture components. Meanwhile, Intel shares are rising 6% in the pre-market after SoftBank agreed to buy $2 billion of the chipmaker's stock. The news coming as the U.S. government looks to take a stake in the company. Sources telling us here at Bloomberg, the Trump administration could take a 10% stake in Intel using funds from the CHIPS Act. And too bad Annmarie isn't here for this one. Chinese toy maker Pop Mart reported robust revenue and profit growth, boosted by global demand for its Labubu dolls. You can see them there. The pointy-eared, sharp-toothed monster's popularity has been fueled by blind box packaging, pushing repeated purchases. The CEO saying he expects foreign sales to likely outpace the domestic Chinese market this year. That's your Bloomberg brief. John?
Yahira, thank you. Thanks for this morning. Annmarie taking a well-earned day off. What are you Googling? You're having a little look at something, aren't you? You're looking at the price of them. What are you checking? Go on.
Fake Labubu dolls.
How much?
Known as Lafufus are serious choking hazards. So don't get a Lafufu if you want for your kids.
I knew you were up to something.
Why did you want me to tell everybody about that?
I just could see that you looked entertained.
Don't buy a Lafufu.
There you go. Up next on the program, we'll set you up the day ahead, plus an important conversation with Gene Soroka of the Port of Los Angeles as shippers race to beat tariff deadlines. That conversation up next.
The long end getting unanchored, sell America or the deficit, that's like very April. You look at the sell America trade, we're not seeing evidence that foreign investors have stayed away. I think markets across the board are pricing in a soft landing and what Governor Waller called good news rate cuts.
So April is the biggest bond market diss I've heard. over the last month. Priya Misra, JP Morgan, a little bit earlier on this morning.
Yeah, but it's so true, and it just highlights just how much the narratives have been shifting. Get over yourself. That is so April.
So April.
Yeah.
Equities right now down about 0.1% on the S&P 500. Bond yields down about a single basis point across the curve. With your morning movers, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. One of the best performers in the S&P pre-market is Palo Alto, reporting earnings yesterday. It was a better 2026 than expected. They have a whole suite of cybersecurity offerings. That big platform seeming to do well with customers. So those shares up 6.6% rather. Perhaps one of the surprise gainers of the day is Home Depot when they reported earnings with a miss on comparable same-store sales and a less purchasing of big-ticket items. Initially, they sank, now up 1.7%. It would seem a lot of the commentary coming out of the sell-side community, including D.A. Davidson, saying that it was in line and the trend is positive. Therefore, all in all, a solid earnings report. Not perhaps a solid earnings report was Viking. This is the high-end luxury cruise operator. They had bookings that were solid. They had half of 2026 booked out too, but still shares down 3.8%. The problem, according to strategists, was that they were only able to raise ticket prices 4% for this year. That is a slower growth than last year. The concern now is, are they losing pricing power? John.
Danny, thank you. I don't do cruises, but if I did.
I knew you were going to say this. I know, going through the fjords.
Like that river cruise?
I know, it looks pretty awesome.
That looks pretty awesome, doesn't it?
Either Croatia or the fjords of Norway. And there are a couple of those,
They're sort of partial to the fjords.
Yeah, I think that
look very
cool,
pretty.
Yeah, they're beautiful.
Team
I
outing.
like cold weather.
TK always wanted to make that team cruise happen.
Yeah. Do you think that you want to be on a boat with people who want to talk to you?
No, probably not. And then stuck there and not be able to leave.
Yeah,
I think I'd really struggle with that, actually, yeah.
I think that sounds like your dream.
Not that I should joke about this kind of thing, but like man overboard, you know? Like,
all right.
Swim into the...
Yeah.
And if you did that in a river, you'd make it, right? You'd get to shore. Probably. I don't suggest doing that.
This is going to a really dark place.
Let's turn to trade.
Jump overboard.
The Port of Los Angeles seeing the best month for cargo volume in its history in July. The port's executive director, Gene Soroka, saying traders front-loading cargo ahead of tariffs caused the spike. Gene joins us now for more. Gene, welcome to the program, sir. There was a quote from you in the last few weeks that we were talking about around this table. It's been a roller coaster ride all year long, and the ride's not over yet. Gene, just take a moment just to describe what the last few months, in fact, what this year so far has been like for you and the team.
Good morning, John and Lisa. It has been a roller coaster. Interestingly enough, when hard tariff policy comes out, cargo plummets. When those policies are softened and deadlines extend, cargo picks up, just like we saw in the back half of June and for that record month of July. Folks just trying to get the import side of the business and cargo in under the wire of these changing deadlines.
Gene, what are the backlogs like now? How much longer does it take to process this with all these different tariffs from all these different countries changing from day to day?
Well, this is what we're most proud of, John, and we've been talking about this for months now, but we weren't caught off guard. Thanks to the port optimizer that we've developed with the Wabtec Corporation, we can see cargo 40 days before it arrives in Los Angeles, and we did just that last month, processing 107 ships, 30% more than the 5-year average, with not one backup on water or land. The cargo moving through the terminals at 3 days out by truck is a pre-pandemic low.
Gene, this comes after all of the disruptions and some of the lessons learned. I am wondering what you are seeing in terms of the composition of imports to the United States and whether that has shifted. Yes, there are these pockets of big surges and then declines on the heels of tariff policies, but has there been any consistency, say, about shipments from China or shipments from India that really come to your mind?
Lisa, you're right. We did learn a lot. We're working closer together than ever. We're using technology to help us wherever we can. What we have seen is cargo emanating from China really dropping. Back in 2018, it was 60% of our portfolio. Today, it's 45% and continuing to decline. An uptick from Vietnam, Indonesia, Malaysia, Thailand. Not so much from India. And with the 50% tariffs that were slapped on that country, I don't see much change there yet. But definitely a shift to Southeast Asia and more liner services of the nonstop variety being put in to keep that speed component in place for us here in Los Angeles.
How quickly do you see some of the importers shifting their orders on the heels of different policy prescriptions from the White House? I mean, can you just give us a sense of how much in real time all of these companies are adapting and adjusting, to use our friend Tom Keene's phrase, to what's coming out of Washington and taking those opportunities to pounce when there's an opening?
Right, Lisa, they're showing so much resilience on the import side of the business, but it's not transactional. It takes a retailer about 3 months to put an order in and get the products ready to ship. In the auto sector, the tiered suppliers are at about a month and a half. But when those windows have opened, we've seen orders finalized, even backlogs of inventory on the Asia side scooped up and brought over. This is the fastest pace we've seen in that changing trade policy and the reaction from the import shipping community that I can recall.
So, Gene, have you seen any slowdown? I believe that you have something like a 3 weeks, 4 weeks maybe view on the kind of traffic that's going to come through, the kind of volume that's going to come through over the next 3-4 months. Gene, how are you thinking about that now? Do you see any slowdown in the pipeline whatsoever?
I do, John, and I think history will show that we peaked in the month of July, which is a little bit early considering year-end holidays and the traditional seasonal products that come through. But August looks pretty good right now, between 900 and 950,000 container units. Yet that would be about a 7 to 10% drop compared to our previous month. And we'll probably see 3 weeks out from now a real dip in cargo, down about 20%, because folks have brought in just about all the inventory they can off those open orders and for pre-positioning inventory the way they want to look at the end of Q3 and Q4.
Gene, just before you go, just one final question. You've been following the conversation on this program. I know you have, because you follow the conversations on here. I just wonder if there's something people are missing at the moment. You're in a unique seat. Do you think people are missing something just in the trade story at the moment? And if so, what is it?
Well, I think it's been recounted a number of times that the big box retailers, home improvement stores, those that had the capability brought a lot of inventory in since last summertime when this talk began on the campaign trail. Going through that level of inventory has not yielded the pass-through to consumers that some have seen, but it'll come. It's the small to middle-sized folks that I'm really concerned with right now, dipping into their savings to pay these elevated prices, get the cargo cleared at ports like Los Angeles, paying up to 55% tax on those goods, like product coming from China. So it's the small to middle-sized firms that make up a lot of employment across this country that we've got to watch real closely over the next weeks and months.
Gene, you're one of the best. Thanks for making time for us. We appreciate it. Gene Soroka there of the Port of Los Angeles. That final point, a really important one.
And it's the one that really has people looking to future CPI and PPI prints to understand exactly what the inflationary ramifications will be from tariffs.
Conversation continues tomorrow. Target up next. Brian Nick of New Edge Wealth will join us. David Seif of Nomura will catch up with Alicia Levine of BNY Wealth and Seema Shah of Principal Asset Management. Live from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.